acceleration of sales in 30 markets. I thought that was significant.
It's a hilarious note because they flirted with downgrading it, and then they end up raising the target to 490.
Yeah, it was a very funny.
They also make a great point that if they're going to succeed in robotaxi, sales of deliveries are going to suffer. It's just going to be part of it. They are willing to look past this cycle of auto deliveries. That's why they argue in the comp package, the targets for deliveries are not that aggressive.
It can be met. They can't be met. I do like the fact that the people who followed it all the way down are now going all the way up. Like, I'm cutting my price target to 390. Now that guy is now saying, I'm raising my price target to 470.
Right.
How do you feel about that? That value add?
I don't think it's of any value at all.
There you go. I was just
there was an FT piece today just detailing the large amount of turnover at any number of the Musk companies, including Tesla, but also XAI and others. But certainly Tesla, a lot of names, man, in terms of the exodus there. You see it.
Well, I don't know if you really want to
how hard they work.
I think it's a limited time that you can work for.
It's
kind of like the NFL.
It is.
Right?
You pace
burnout. You really want to
how hard they work. 100-hour weeks, if not even more. It seems almost inconceivable. And so it is difficult to do that. Guys, wanted to move it over to the financials if I can. Jeffries reported stocks actually not doing much.
Yeah, stocks
Looked
not
like a pretty strong
representative that quarter.
Looked like a pretty strong quarter.
It was an amazing quarter.
For Jeffries. We mention it not only because Jeffries is a $14 billion market cap company and worthy of that, but also because it's often a tell for a lot of the capital markets activity overall, deal making and things of that nature, and so can be helpful in terms of determining what we may see from the likes of Goldman Sachs or many others. And then you see it just positive a bit. But as Jim said, a strong quarter across the board.
Oh, my God.
And then I would come back to yesterday's enormous deal, taking private of EA. And just again to remind people, $20 billion is the commitment, sole commitment from JP Morgan. No private credit firms there at all.
Even a year ago.
And that just shows the power of deal making and what it can mean for these companies, because the fee associated with that's not going to be insignificant. It's a single B credit, by the way, and JP Morgan stepped up to it, I'm told, only 11 days ago.
Incredible.
And they said, yeah, we'll do it. We'll do it all.
Not syndicated, just like, hey, we'll take it.
And they're going to sell around the world in all sorts of different ways. They'll keep some, but as well. But worth noting, Jim, because you've made the point many times how important deal making can be for these firms. And again, the fees associated with it, oftentimes around the financing for a transaction, the likes of which, of course, is the largest go private of all time, can be quite significant. Even though the equity check was $36 billion, $20 billion is still a pretty big number.
It sure is.
For one firm to take on.
I look at it 16 times earnings. I think there are so many companies that have a higher price to earnings multiple. When are they going to accord this multiple deserves? Because this is no longer a net interest income story. This is a story about growth. And people have to recognize that's a big share take from other companies that we might have at one point or another say, oh, they're in there. I mean, don't forget. I mean, this is not, you do not have the usual syndicate of names that I expected to see.
Right.
It's incredible.
No, it was interesting they took it on themselves. And from what I continue to hear, there is certainly a great deal of hope, Carl, that we will see, and you asked this question a lot, a continued uptick in deal-making activity. A lot of inquiries, I'm told, in terms of financing. We'll see if it actually comes through in the actual deals, because there are always gating issues, whether it be around price or social issues or any number of other things. Although in this environment, the regulatory, it's not the same questions you're typically asking.
That's really important.
For example, there was a time when you could imagine the Saudis buying Electronic Arts, and Sarah brought this up yesterday. It will be a CFIUS review. You could argue, well, wait a second, average age, you got a bunch of people playing these games every day in the United States. How different is that than TikTok? And should that be national security?
Yeah, you put Saquon on the cover and it's a jinx.
Doesn't appear that that's going to be an issue here.
Yeah, I like the line in the FT today. What regulator is going to say no to the president's son-in-law?
That's a good point.
Jared Kushner obviously involved, and that is why you're not going to hear much in terms of a regulatory impediment to this deal getting to the finish line, with obviously the Saudis will own Electronic Arts, along with Silver Lake, Jared Kushner's firm Affinity, but they will be, as I said yesterday, effectively the owner. They're the largest part by far of that $36 billion in equity.
And one of the things that I think is happening apropos of this is we're seeing the best. You put up those Mag 7, how they're doing.
Yeah.
I will take them and see them and then raise them with Jane Fraser. That stock city is up 47%. That's a high growth. That's a static company going to higher growth.
Well, the Journal did that piece a few days ago about their new AI pilot program. Our own Q Son did a piece this morning for Squawk about JP Morgan's AI efforts.
I love that.
Well, you could develop a pitch book overnight with a fraction of the number of bankers and have it done all around the world, ready to go.
Look, I think we're not in a position yet to do anything other than be more anecdotal about the use of it. I almost get the sense that if you're one of these banks, like Jamie Dimon, who spent a lot of time on AI, will say, listen, I want that now. And I don't think you can say, look, I got to get a team together. I think you're the team. Force of one.
Without a doubt, you can do a lot more with fewer people.
Show of force.
There is no doubt. That said, we're going to have this discussion many times. How do you train the next generation of bankers if you aren't having any new entrants coming to your company? You've got to continue to bring people in, one would think, if there is still going to be a human connection somehow in all of these different fields, whether it be banking or law, and go on from there.
Human connection.
Yes, this. See, I can touch
they
you.
were working remote there at half these places. Look, I think that...
Not JP Morgan. What are you talking about?
No, I'm saying law firms. I think the law firms are the places where and audit firms are going to be dramatic.
I'm not hearing any diminution in the incoming classes of law firms.
No, not yet at all. No, 3-4 years. Absolutely right. The software hasn't been developed yet. They're not that savvy, but they will be. And I think that that's where you have anything where you have one person supported by 5. That's where I see maybe that's cut down to 3. That's what you have to worry about.
Right.
Who is the support for the principal? What do you got there?
I just wanted to come back to SATS, the EchoStar, because up again, not
Amazing.
as much as it was in the pre-market. Seeing it up almost 4% this morning. They continue to potentially sell Spectrum there. You wouldn't have even thought they had any left after, of course, the $23 billion cash deal to sell Spectrum to AT&T, the $17 billion cash and stock deal to sell Spectrum to SpaceX for Starlink. But Bloomberg story talking about another, maybe even as much as they have it carried at $9.8 billion. The Spectrum being discussed in potential sale of these AWS-3 licenses to Verizon. And there's Verizon shares. And so you've got this stock up again. It's up 200+% since all this started. And of course, it does come back to something I did discuss with the FCC chairman, Brendan Carr, a couple of weeks back, which is, was there an opportunity here for the U.S. to potentially take these licenses back from EchoStar because they had not fulfilled their obligation to actually build out this way they said they would and realize these proceeds for the U.S. government? He said it's a lot more complicated than it would seem. I think I'm paraphrasing, but certainly an interesting question as Charlie Ergen's net worth continues to rise. He's the obviously founder and
are there other
11% shareholder of EchoStar.
Are there other EchoStars where you realize that you didn't realize the thing's worth a fortune? I mean, because this was incredible.
It was incredible.
This is the greatest ugly duckling the swan story I've heard.
Yep.
I thought this thing was dead in the water.
Yep. As many did. Many thought bankruptcy was actually coming instead of an incredible accretion of value. You can see what's happened to that.
It's a great American story.
What's happened to that stock.
It's a great American story. Meanwhile, not a great American story is Paychex today. Stock is down 7. I have them on tonight. I've got to tell you, this stock goes down hard after every single quarter, and you look at it three weeks later, and it is up. I've got to do more. I don't want to cuff it, but Paychex has had a history of going down very big, and then we have one, and you say, what was I thinking? Kind of like the Micron situation last week when we had Sanjay on. It was just a remarkable story, and suddenly the thing's getting crushed. This thing's getting crushed. This is a small to medium-sized business. I can't wait to talk to them and see what the story is.
You think it's related to the macro things we've been talking about?
That's what I'm most worried about. The decline, a possible decline in the growth of customers would be something that the Fed has to be really aware of, because it's the small and medium size that matters. ArcBest is a change. Judy's did a remarkable job, but this is a company that's almost entirely given to AI and logistics. Again, when I'm looking for people who say AI and they're really doing spreadsheets versus the people who say AI and it's a chat GPT moment. I find that you saw J&J over 180 today. They have a big cancer franchise. They want to do more AI. The AI has not really gotten to the point where I'm surprised in medicine. That's one of the places where I think people are saying, wait a second, if it's so good, why hasn't multiple myeloma been tackled?
Right.
And it takes time. Look at that stock, will you? That started taking off when they figured out how to beat one of their biggest patent expirations. But then also they beat the plaintiff's bar.
Yep. Remember those days we talked about what was going to happen with that sort of. Would there be a step function in legal exposure?
And Alex Gorski came on the show and said, Jim, the stock was dramatically lower. This is something you've got to understand is not going to hurt our stock. And look, it's been good. Versus a lot of the other drug companies. Even Lilius is stagnated.
It's kind of stalled.
Did you see the Novo Nordisk note that came out?
Yeah.
It was like, the people at Zinder in Beau Jest. It's like every man dead or alive must do his part. I mean, look at that. It says basically, listen, you got to take a hit.
Right. Of course, they've had layoffs. Exxon today with 2,000 global layoffs.
Saw that.
3 to 4%. By the way, oil, Jim, is going to have its probably lowest quarterly close since 21.
I think that one of the things where the president is getting very lucky, or maybe you'd say very good, the price of gasoline is going down in this country. I think that we can talk all about all sorts of inflation, but the pump does matter. It is not. I mean, I was pumping this week. I said, "Oh my God, what a great break I'm getting!" But the one to watch, the one that I'm willing to say is, and I'm calling it peak, and it's killed a lot of people calling the peak. I think that cattle's coming down. I think steaks could get cheaper.
I saw you say this last night.
You've been saying this for the last week or two.
Yes, because I think it's breaking. I think it's finally the rollover. I think you have a parabolic chart, and I think that, and I'm using my friend Carly Garner, who is an expert in commodities. This 3% break for this month is the first down month in a long time. If you have steak coming down and you have gasoline coming down, not that I would ever eat those two together, David. This could be the big break that the president wants. But I think the president's focused on other things. He should focus on the fact that commodity prices are coming down every day. That is huge.
Guys, I just wanted to come back to CoreWeave because it is one of the best performers of the morning.
What did I tell you?
Was up over 13% last I looked. We can take a quick look now on this deal with Meta, $14.2 billion through December 14th of 2031. In terms of Meta, obviously leasing capacity from CoreWeave. There it is. Look at that move. Not the all-time high. That was 160. Right number around 165. By the way, they are still in the contract to buy Core Scientific, but the vote on that is October 30th of Core Scientific shareholders. And many of them are aligned against the current deal in terms of the ratio of CoreWeave shares, saying that the comp set for Core Scientific, CORZ is the symbol there, has gone up much more than Core Scientific has during the same period because it was locked into this deal with CoreWeave. They want a higher ratio, and we'll see whether they can get it. Again, that vote now set for October the 30th. But did want to point that out.
CoreWeave and Robinhood are my two faves right here. Robinhood up again.
Meantime, Chicago PMI out a couple moments ago. Let's get to Rick Santelli on that. Morning, Rick.
Good morning, Carl. Another disappointing Chicago PMI. Our September read comes in light at 40.6. We're expecting a number 43 or higher. This is now the 22nd consecutive month under 50 or contraction territory. Last time we were above 50 was November of 23. We see that interest rates are melting a bit here. We're down a couple of basis points pretty much on the entire curve. We're expecting jolts at the top of the hour. And if there's a closure of the government, that might be one of the last job reports. We might not get Friday's big jobs report. So jolts will be very important, along with consumer confidence, all to come in about 15 minutes. But between then and now, well, Squawk on the Street's going to take a very short break.
We've been talking a lot about CEO succession last couple of days, whether that's our own parent or CSX or Barrick. Today at Spotify, going to Alex Nordstrom and Gustav Sonderstrom, the chief product and CTOs, as co-CEOs. Daniel Ek moves to executive chair. Jim, and busy month on succession.
Yeah, it sure is. And I got to tell you, I think these two guys are ready. If you sell this one right now, it's like selling when Reed Hastings stepped down and you had two co-CEOs, and look out. So do not sell your Spotify. I think this is very strong.
Otherwise, pretty tight range for markets. Dow's down 6. Don't go anywhere. It's time for Jim and Stop Trading.
Some executives really get it, and Rob Katz is one of them. He's the CEO of the underperforming Vail, and he comes out and says this, and I know, David, listen up, because this is something you never hear. At the heart of our underperformance is that the way we are connecting with guests has not kept pace with the rapidly evolving consumer landscape. We have not fully capitalized our competitive advantages. He just basically just says, listen, we're not getting the job done. I'm glad to hear he didn't blame the consumer. He's blaming the execution. And it would have been very easy for him to say we're worried about the shaky times and worried about all the different problems. No, he blames himself, and he goes over what they did wrong, including like even getting the lifts right. Now, does that mean you can buy it? I think at least when you see that they need to make a change in the way they do it. He actually says, he says, listen, we need a new marketing officer on the call. But the call is very apologetic, and I think people should read it when you see somebody who's honest enough like Rob, and he sent me a really good note last night, and basically, again, saying, fallen sword, my fault, team fault.
Yeah, we talked to Carnival yesterday, and Money Movers tried to probe for signs of softness. They wouldn't offer any.
No, and Vail's not blaming the customer. Amen. Thank you, Rob. Thank you for doing it right, for not blaming the customer.
Jim, on your book again, congratulations.
Thank
You're
you.
going to make your way to the bookstore
Yes,
now.
at Barnes & Noble. It's at 5th Avenue and 46 at noon. And some people have to register. You should register, I think, at this point. But my colleagues, I thank you very much for everything that you did. Read the back. You'll like it.
I like it all.
Ah, well, there you go.
Yeah.
And I like you all.
Oh, thank you. All right.
I didn't credit your mother. I should have put your mother.
Yeah,
That
of
was my
course. Always.
biggest
Yeah,
mistake.
she always should come first. I'll let you know which subway line to take is best to get you to 46 and 5th.
Someone
I'll
said
text you.
A,
I'll
B,
let you
and
know.
Pretty
Q.
straightforward.
Yeah,
Like
might
the
be.
Q.
Yeah, well, I wouldn't do the Q. You
See?
want something down here.
All right.
Jim, we'll see you tonight,
Thank
and some we'll see you before. Of course, Jim and signing his new book. We're back in a minute.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber. We are live, as always, from Post 9 at the New York Stock Exchange. Take a look at stocks this morning. We're under a little bit of pressure, although not really. The S&P 500 is unchanged, masking some of the strength beneath the surface. CoreWeave, for instance, popping double digits on this Meta deal. The Dow is up about 59 points. We are awaiting the job openings report any minute now. Let's take a look at how treasuries are faring ahead of that, as it looks increasingly likely we're barreling toward this government shutdown. 10-year yield 4.1%. So some buying of treasuries. That's been a trend so far this week. Coming up this hour, countdown to the shutdown. We'll talk to former Trump administration official Mark Short about the wide-ranging impacts of a government stoppage, how long it could last. Plus, NVIDIA competitor Cerebras Systems just raising more than $1 billion in new funding at an $8.1 billion valuation. We'll talk to the company CEO in a first on CNBC interview. Also ahead, Jimmy Fallon with us ahead of tonight's launch of his new business competition show, On Brand. with Jimmy Fallon. Lots to talk about with the late night host. But for now, Carl, technology, healthcare materials, only sectors green.
Conference board and Jolt's on the tape as well. Let's get to Rick Santelli again. Hey, Rick.
Yes, on Jolts, this is an August read. Openings expected to be right around 7.2 million. A little bit extra horsepower, 7,227,000. That'll be the best number since, well, just June. But in the rearview mirror, a nice upward revision. Last month, originally reported 7,181,000, becomes 7,208 makes it the second weakest. The big number month now is March at 7,200,000, the lowest job openings of the year. If you look at Conference Board, these are September confidence numbers, and boy, they're disappointing. If we look at the headline, well below expectations at 94.2, the weakest since April of this year, sequentially lower, even though there was subtle positive revisions to all three metrics last month. If we look at the present situation, another big disappointment, 125.4, the weakest in September of 2024, well below 132.4 in the rearview mirror for our August final. And finally, expectations at 73.4. That is the weakest since June of this year, and much sequentially lower, of course, than 74.7. So confidence disappoints. Positive revision and a better Jolts number on the openings. We made the low yield of the session in treasuries on those data points. That's coming in right around 410 plus on a 10-year. Sarah, back to you.
Hey, thank you. Perhaps those job openings data take on a little more importance if we don't get the monthly jobs report on Friday. We will still get ADP, though, on Wednesday. That's the private sector jobs. But, guys, it's the end of the quarter, so I just wanted to look at some interesting moves across markets that we don't necessarily always pay close attention to. The first, star performer, gold, really shining again during the month of September, during the quarter, and so far the year. It's just been the steady climb up. It's up 16%, as you can see, for the quarter on gold. It's tracking for its best year since 1979, up more than 45%. Why? Dollar's weaker. I don't know. Let's watch it during a shutdown. Is it a safe haven status? The Chinese buying, all these reasons that you're given and that you hear about gold. It's notable that it's up so much at a time where, it hasn't been kind of like this risk-off scary period for the markets where it's been a flight to safety. Gold is up as stocks have rallied as well. And then let's just look at the flip side of that trade, which is the U.S. dollar. It's something I'll be watching into the shutdown because of all the markets, how everybody says stocks and bonds brush off shutdowns. Dollar has typically actually reacted negatively around shutdowns. Dollar is what you watch when you're worried about, government credibility and politics, Fed credibility. I remember Ken Griffin last week telling me that he thinks the weak dollar could be signifying something about credibility of U.S. assets, including Fed independence. That's a big theme for him. Look at the dollar index. It's weaker right now, and year to date, it's down 10%. That is a pretty sizable decline for the U.S. dollar. So helps explain the rise in gold, but also, I think, leads to some bigger questions about what ultimately that means about the allure of U.S. assets.
Yeah, some commentary out of the ECB today about the euro and urging action to make the euro an anchor of stability, which I know you always hate.
No, I don't hate it. They've been trying to do that since the euro was born in the 90s, and it has. It's the second most widely held currency, but they do take opportunities sometime when the dollar's down and when there are questions about the U.S. system to call for banding together to make it a credible alternative, and that just never fully materializes because there really isn't any game in town other than the U.S. dollar at this point. How about treasuries? Interestingly, treasuries have rallied for a third quarter in a row with lower yields. It's not super dramatic, but it is notable amid worries about inflation. Everyone said the tariffs were going to be super inflationary. As the Fed has cut interest rates, as maybe there's some slowdown concerns, certainly in the job market, treasuries have rallied. So you're getting this quarterly rise in treasuries as well, and that's where you see yields lower. And then finally, guys, Chinese stocks. They've actually been world beating since the April low on tariffs. You can look at the ETF. There's the China large cap ETF, but Chinese stocks have been significantly higher. They added 9% in September, the MSCI China, that is, fifth straight month in a row, and since bottoming in April, rallying 40%. 9%.
Yeah, FXI.
Remember when everyone hated China?
Yeah, I remember. It's up 9 out of 10 months, and it's a double from the 2024 low. We all remember Tepper's appearance on Squawk.
True. I mean, look, it's AI, it's easing geopolitical tensions, increasingly less worries about tariff pressure as they find new markets, policy support. You can add that all in there, but it is interesting. They're on their Golden Week holiday right now, and then they're going to have a discussion about a 5-year plan.
Some of their most
They're
important
bullish.
companies, like ours, are private too. I think ByteDance obviously talked a lot about that in the last couple of weeks, given TikTok. DeepSeek still private, so could be even more there. At
Yes,
some point.
I mean like us, they do have big AI champions.
Yes, they
and
do.
AI
Now,
players.
Alibaba is a name that we go to both as a reflection of the consumer in China, but also lately it's been moving up in part because of their efforts in cloud/AI.
Look at that, 60%.
Yeah.
Quarter to date.
Yeah,
Really strong.
That is very strong.
Meantime, speaking of the quarter, stocks are finishing out a strong one. The NASDAQ leading the major averages, up more than 10% since the beginning of July. S&P up more than 7%, Dow up 5%. Let's get the setup for Q4 now with Paul Hickey, who's here at Post 9, of course, the co-founder of Bespoke Investment Group. Paul, thanks for coming in. Good to see you as always. First, thoughts on Q3?
A very impressive quarter. I think the strength in gold is purely not only a reflection of the weak dollar, but weak currencies overall. I think the markets are going to hard assets, and gold has been strong. The dollar is weakest through Q3, one of the weakest, I think, maybe the second since 1973. So you're going to see gold go up there. And I think the strength in China is a reflection of also what, Sarah, you were referring to. Also, valuations there's such a wide valuation gap between the two that investors, it's so out of favor that investors are going in there.
Right. Are you poised for a chase going into year end?
I think so. I think coming into the end of the quarter and early in the fourth quarter, we're a little bit more conservative because you take a step back to, say, April, and as unsustainable as the selling was during the tariff tantrum, the pace of buying that we have now, we're at magnitude levels versus the 200-day moving average above as we were below in some sectors in April. So that kind of pace isn't sustainable either. So you do need a pause going into earnings season, which I think what we've seen over the last week just a pause, it's not even a pullback, it's a pause, is perfectly healthy and sets the stage for a positive rally into year end.
Right. So you don't look askance at some of the 12-month 7,200s or 7K year-end out of BMO, things like that.
No, I mean, strength begets strength in markets. And when you have the market up 10% or more in the first 3 quarters of the year, fourth quarter is even stronger than it normally is.
And less volatile, too, yeah?
Less volatile. And what you have to just look at supply and demand. The underlying bid that we've seen in the market this year, you just look at the market performance from the open to close. Since SPY, the ETF, started trading, the only years where it was comparably as strong were 95, 2003, 2009, and 2023. And those were all very good years for the market and very strong years.
I mean, it continues to be 2 factors. If you look at the sector performance quarter to date, technology on top, and that's the AI story.
Right.
And then the cyclicals right behind them, and then the defensives underperform. So this combination of better economy, better outlook, and AI is what's fueling
I mean,
it.
that's exactly what you want to see is the defensives underperforming, and the strength in the cyclicals is, that's an encouraging, because for concerns about the economy weakening, the Fed having to cut more because the economy is supposedly getting a lot weaker, which you just look at the data, it doesn't seem to be that way. Economic data over the last month has been coming in above expectations at a much higher than average rate. Momentum in indicators versus a year-over-year range has been improving. And you look at the performance of the semis, which we think are a very good economic barometer. They were underperforming late last year when it was just the mega caps outperforming, and they were underperforming. They bottomed in April with the overall market, and their relative strength has been doing very well over the last year. So that's a good sign.
Which kind of brings us to this ongoing discussion of whether we can have a big, huge run in tech investment and a great stock market as a result, and real weakness in labor if one's trying to supplant the other. You think that's what's going on?
I mean, I don't know. Maybe real weakness in labor isn't perfect. It's a slowdown in the labor market, but the JOLTS report was better than expected today. Jobless claims have been holding up.
I'm looking
very
at 6-month trends on private employment.
Right,
It's
so
not a pretty chart.
No, it's slowing, but it's not this cataclysmic event that we're seeing. And the leading indicators of jobless claims are more real time, and they've been showing strength lately, which is encouraging to us. So, but yeah, the economy is certainly slowing. You're seeing some bifurcation. Breadth has been very this month. It's crazy. We've had 12 up days. Breadth was negative on 7 of them.
Yeah.
So I mean, that's unheard of to see that kind of disparity. And in the short term, you don't have to get too worried about those. If we come back a month or two from now and we're still seeing those kind of disparities, I'd be much more nervous heading into 2026.
Paul, we'll talk to you then, if not before.
All right, cool.
Good to see you.
Good to
Paul,
see you
thank
guys.
May have noticed some of the pharmaceutical names have moved up sharply in the last few minutes. We got some breaking news out of Washington on drug pricing. Eamon Javers has the details, perhaps filling us in on why we've seen this move. Eamon.
Yeah, David, it is pharmaceutical related, and we don't have all the details right now. We're trying to solve a mystery in real time here, which is that the president has an event on his calendar at 11 a.m. just scheduled as an announcement. And the question is, what is that announcement? Well, our Angelica Peebles at CNBC has some reporting here from a source familiar saying that this announcement is pharmaceutical related. It's discounted prices in Medicaid, a 3-year reprieve on tariffs as long as the products are being built in the United States, and additional agreements with the United States. Now, the Washington Post is reporting just within the past couple of minutes that the president is going to announce an agreement with pharmaceutical giant Pfizer to voluntarily sell its medications through Medicaid at lower prices. And the White House confirms for me, guys, that this announcement will be pharmaceutical related. It is an individual company that is cutting a deal with the White House. And the White House, as of this moment, not confirming the name to me of that company, but the Washington Post reporting that it's Pfizer. And there you see the stock moving on that news from the Post. So we're going to work on some more details of what exactly is in this proposal. But for now, what we can tell you is that it's related to pharmaceutical pricing. It's an individual company. It's cutting a deal with the White House to lower prices across the board. And as you guys know, the president has made pharmaceutical pricing one of the goals of his presidency, to lower drug prices across the board. So this would be seen by the White House as a significant win, guys. Back over to you.
A little more color. Journal also has, it's going to be called Trump RX, which would allow people to pay cash for certain drugs directly from a government website. And just to follow our reporting there, Pfizer plans to be a part of it, though it's unclear whether other companies will be a part of it and what it means for people who are already, on insurance like Medicare or Medicaid. But
yeah, the Trump RX piece is, obviously it's a significant branding initiative. We don't have that confirmed. We're going to work on confirming that. No indication that that's wrong from that publication, but we're working it through with our sources as best we can in real time here.
Eamon, what time are we expecting to hear from the president on this?
11 o'clock is when the event is on his calendar. Now, he's over at Quantico, Virginia, making a speech related to the military right now. So at some point, he will be back here at the White House, and we'll get a better read on exactly when we'll see that announcement. But if it is Pfizer, you would imagine you'd see the CEO here at the White House, along with maybe some industry folks as well, and a number of people by the president's side when he does make that announcement.
okay, we'll look for it, Eamon. Thank you very much. Keep us posted. Pfizer moving up now more than 3.5%. Here's our roadmap for you for the rest of the hour. After the break, former Trump administration insider Mark Short on why this potential shutdown is different from the others and the one thing that could ultimately lead to a compromise.
Plus, we'll have more headlines about big money flowing into the so-called AI trade, including $1 billion raise for a private company called Cerebras. We're going to talk to the firm's CEO about how it's taking on industry giant NVIDIA.
And don't miss Jimmy Fallon with us live ahead of the launch of his new business-focused reality show tonight. Squawk on the Street is back after a short break.
They are pursuing a very reckless strategy right now, and for the life of me, I cannot understand what they hope to accomplish other than giving themselves temporary political cover from the far left portion of their base who are demanding that they fight Trump. There is no basis whatsoever for them to oppose this continuing resolution.
That was House Speaker Mike Johnson this morning on Squawk Box as the government heads toward a shutdown at midnight tonight. Joining us now is Mark Short, Advancing American Freedom Board Chair. Mark was also the former White House Legislative Director during the first Trump administration and former Chief of Staff for the Office of Vice President Mike Pence. It's good to have you back, Mark. So,
thanks, sir.
What do you think happens here?
Look, I think we're headed to a shutdown. I think it's frankly to the points that Speaker Johnson just made. I do think Republicans have been there before. I think typically most of the shutdowns in the last few years have been Republicans looking to contain spending. And in some cases, there wasn't really an out, but you're feeling pressure from the base of your party to do something in opposition. And I think that's where Democrats find themselves today. I think it's a little bit hard to explain when Republicans pass resolutions in the House, continuing funding at existing levels, and Democrats actually saying we're going to shut it down because we want $1 trillion in more spending. I think is a hard argument to make, but I think this is less about the policy, and it's really more about the politics of where their party is right now and wanting to show opposition to President Trump.
So how long do you think this lasts?
That's a great question because, again, if there was a policy solution, it'd be a lot easier. But I think that probably the pressure will build on Democrats that there's a pathway out in that one of the positions they have is one that Republicans, I think, unfortunately, have signaled they'll accept, which is to extend the Obamacare subsidies. I just think Republicans have wanted to do that at the end of the year. And so I think there's a pathway for Democrats to claim they got that concession from Republicans to schedule that vote. But I think, all Republicans voted against those subsidies when it was part of the COVID legislation. And now it seems there's a large number that actually want it extended.
I wonder what the court of public opinion is going to decide here, because the Democrats are making this about health care. They're making it about Medicaid cuts and the big, beautiful bill. They're making it about the subsidies, the COVID era health care subsidies, as you just mentioned. At the same time, we're expecting this announcement from President Trump this morning, as our Eamon Javers just reported, on making drug prices lower and getting more access to lower cost drugs for Americans. And I do wonder if that's kind of a strategic play here for getting the high road on this healthcare issue as the Democrats try to make the shutdown about it.
Well, I think it's probably viewed by most Americans as a pox on both houses. I do personally think the Democrats are the ones instigating this shutdown because, again, the House has already passed legislation to keep the government open. And I think to support the notion that it's a pox on both houses, Sarah, the irony is that 2 years ago, this same vote came up to extend the government funding at Biden levels. And it was one of the reasons Republicans overthrew Kevin McCarthy as Speaker and replaced him because they said, we can't do that. And yet here we are 2 years later, and almost every Republican except for Thomas Massie, Rand Paul are saying, oh, no, we're supportive. And every Democrat 2 years ago who was supportive is now opposed to this continuing resolution at spending levels that Biden had passed. And so I think for a lot of Americans, there'll just be a sense of kind of a pox on both houses.
So what gets it done, and how long does it go on for, Mark?
Well, again, I think that it's one that doesn't have this sort of easy, okay, here's we're going to negotiate on a top level spending. That's usually what drives these sorts of shutdowns. And so I think at some point the Democrats will say, okay, there's been enough bloodletting at this point, and so we need to have a pathway forward. And they'll announce a deal to say we're going to get these Obamacare subsidies extended at the end of the year. Again, I think that's a position Republicans are already giving them, which is why I think this shutdown is more about show. But I suspect this will go on for a few days because they'll need to show the base of their party that they're standing up to Republicans in Congress and to the Trump administration.
Do you think that there will ultimately be any federal layoffs as a result of it, that the Trump administration will use that to continue to cut costs there?
Well, Sarah, I think that certainly Russ Vought has always been a fiscal hawk, and I think he would want that. I think the question is, will President Trump allow him to do that? In the first administration, when there were a lot of cuts proposed, President Trump actually overruled and opposed OMB's cuts that they proposed. I think now the president is in a more revenge scenario against the federal government, so he may want to allow some of those to move forward. But ultimately, I think that it's going to be a decision internally to the White House whether Trump allows OMB to continue with those.
All right, Mark, thanks for the perspective. It's always good to hear from you. Mark Short.
Thanks for having me.
Still ahead, we'll talk about this latest AI mega deal as CoreWeaving, some multi-billion-dollar agreement with Meta. And speaking of AI, we'll check in with a private chip maker taking on NVIDIA, fresh off a new funding round, valuing the company at more than $8 billion. And don't miss our conversation with Jimmy Fallon today ahead of the premiere tonight of his new reality competition show, On Brand. As Squawk on the Street continues.
CNBC's Changemakers, that's our annual list of women transforming business, is now accepting nominations for the 2026 class. And this year you can hear directly from these power players in CNBC's newest podcast. Julia Borson has the details for us. Julia.
Hey, David. Well, the women on our Changemakers list and our new podcast are tackling big problems and embracing AI. Our first episode is with Thrive Global CEO Arianna Huffington. She's working with companies to improve employees' health and is partnering with OpenAI.
The moonshot is that AI and the AI health coach is based on helping people through the AI power of hyper-personalization to get exactly the right nudges at the right time.
GeneDx CEO Catherine Stulin's AI-powered genetic testing company wants to screen every baby to enable early intervention and save billions of dollars in healthcare costs.
Ultimately, when we get to a place where we can screen every baby at birth, we want to be in a position where we can intervene as early as possible to connect them based on their genetic diagnosis with the specific therapy that might be individualized for them or another medical intervention.
With the percentage of women on S&P 500 boards and leadership teams declining for the first time in years, it's more important than ever to highlight these odds-defying leaders. So I'm also excited to announce we're kicking off our call for submissions for the CNBC 2026 Changemakers list. You can learn more at cnbc.com/changemakers. Sarah?
Oh, I always have ideas, and I always like this time of year. Thank you, Julia. Also look forward to hearing more from Catherine from GeneDx, very cool company. Julia Borston. Time now for a CNBC News update. Silvana Hanau has it for us. Morning, Silvana.
Sarah, good morning to you. President Trump and Defense Secretary Pete Hegseth addressed military leaders in a rare gathering today at Quantico. The president joined Hegseth in calling for an end to political correctness in the military, while Hegseth outlined 10 new directives for the military. They include new physical fitness standards and efforts to rid forces of wokeness. Hegseth said leaders should resign if they don't agree with his views. A second detainee has died in a shooting last week at the Immigration and Customs Enforcement facility in Dallas. The League of United Latin American Citizens said in a statement, Miguel Angel Garcia Hernandez was removed from life support after he was injured in the ambush. The shooter died from a self-inflicted gunshot wound. Officials say he was targeting ICE agents and ICE personnel. A federal judge ordered the Trump administration to pause the layoffs of hundreds of Voice of America employees. Carrie Lake, the government-funded broadcaster's acting CEO, said in late August the roughly 530 job cuts would take effect today, Sarah.
Okay, thank you, Silvana. Still ahead. The man behind private chipmaker and NVIDIA challenger Cerebras, on the heels of a new billion-dollar funding round, valuing the firm at now more than $8 billion. He joins us next. And as we wrap up a strong month and quarter for the markets, does the AI trade still have room to run? Citigroup's head of tech and communication joins us later with his take. Stay with us. Welcome back. Another major deal in the AI space today. CoreWeave shares jumping up now more than 15% on news of a $14.2 billion agreement with Meta to supply compute power. That's after CoreWeave last week expanded its agreement with OpenAI by more than $6 billion. CoreWeave's news also comes after that blockbuster deal between NVIDIA and OpenAI last week, where NVIDIA said it planned to invest up to $100 billion in OpenAI as part of its data center build out. We just had Mike and Trader, the CEO of CoreWeave, on the show last week, and he was talking about, just the scale of what is needed, right? The money, the billions of dollars here, and just the amount of compute power that is needed as he works out all of these deals, some of these neo clouds, as they're called, where they rent out, the compute.
They don't even
really
own oftentimes the data center. They actually just put everything into it.
They rent access to the advanced chips.
And I've made the point, and I think it's worth making again, is we talk about the enormous CapEx plans of the likes of Meta. We all know their numbers. Where are they? $65, $70 billion. But the $14.2 billion that they'll be spending at CoreWeave through at least 2031 as part of this contract, that's operating expense. That's not a CapEx. That doesn't, because they're not paying for this data center. They're simply leasing from CoreWeave.
So the numbers are even bigger.
Even bigger, which moves us on to other AI news this morning as well. AI infrastructure company Cerebras Systems announcing the completion of a new Series G funding round. They raised $1.1 billion. They have now an $8.1 billion post-money valuation. Cerebras Systems founder and CEO Andrew Feldman joins us. It's a first on CNBC. Good to have you, Andrew.
Thank you for having me.
You're welcome. You pitch yourself as a more efficient alternative to NVIDIA. That sounds quite promising. But what does that mean, and what evidence do you have to support that contention?
Well, first, we are a more efficient alternative. We run it about 20 times faster than NVIDIA GPUs. I think all benchmarks across the industry have shown that. And so we're excited. Speed is an extremely important part of making AI accessible and making it interesting and valuable for users.
Are your units far larger than were typical, that are typical? I'm just trying to understand sort of what it is that you have in terms of the technology and why it is, as you say, faster than what at least NVIDIA is obviously dominating the market with right now.
Oh, for sure. And today they're the leader and we're the challenger. What we were able to do is to invent a new methodology for making chips. This is our chip. It's the size of a dinner plate. And most chips today are the size of postage stamps. And by making a larger chip, we were able to hold more information on silicon. We were able to process that information more quickly and deliver answers in less time and for less power.
You just raised $1.1 billion. I know there was an effort to go public a little over a year ago. I'm just sort of curious as to how you're viewing your company's progress at this point from a financial point of view, and whether you're going to need another capital raising opportunity in the likes of an IPO.
Well, look, an IPO is not the goal. An IPO is a milestone on the path to building an extraordinary company. And many companies, as you well know, do a late-stage round with public market investors prior to going public. This round was led by Fidelity and Atreides. It had significant participation from Tiger Global, from Valor, from 1789 Capital. And so this positions us extremely well for the extraordinary growth we're currently undergoing.
Yeah, what does that growth look like then? Can you give us some sense? I mean, I'm only relying here on numbers that I see from your former S1, and they're dated, obviously, at this point in terms of, I'm talking 22 to 23 revenue growth. So can you give our viewers a sense as to what it looks like now?
Sure. I think while we do have an S1 on file, you know, I'm limited in what I can say, but we have a shot of being one of the fastest growing companies in the history of semiconductors, right? And so a shot at achieving $1 billion in revenue faster than any other company in history. And so this is an extraordinarily exciting market, as you described earlier in your piece. The number of big deals being done, the yawning demand for AI is lifting all of us. And particularly right now in inference, where performance matters, it's a good time to be in the AI infrastructure business.
What sort of deals are you signing? I know about the big UAE deal, but what about with some of the big hyperscalers that are spending so much with NVIDIA?
Sure, we're engaged with two of the three major U.S. hyperscalers. I think we're engaged with leading neoclouds. I think a particularly exciting market right now is the market for what's called IDEs, or these are firms that use AI to generate code. And there are a collection of leaders that we are engaged with and have massive deployments behind. This is a field in which we are constantly finding new applications for AI and new deployments that really move the dial, whether it's with reasoning models, whether it's with improvements to coding, whether it's in drug design. We have a large partnership with GlaxoSmithKline. Whether it's in healthcare, we have a large partnership with Mayo Clinic. It's really an extraordinary time.
The UAE, though, remains your largest customer. Is that right?
Sure. We do a great deal of business with G42. They're the of the UAE. They are our strategic partner, and we have, together with them, we have trained models in Arabic. We have trained and serve some of the leading scientific AI models through their partner, MBZ the leading AI university in the Middle East. So this partnership has produced extraordinary results.
Can you hold up that chip again? Where are you manufacturing that? Is that made by Taiwan Semi?
This chip here is made by TSMC. This is at the 5 nanometer node, and it is manufactured there. The chip is then brought to the U.S., where we package it and we assemble it into systems with our U.S.-based manufacturing, and then we ship from the U.S.
Are you getting pushback on, I don't know, concentration of revenue among a limited pool of customers?
I think, as your piece earlier described, that this is a game of whales, right? And these are big deals that are being done. And I think if you look at even someone who's got the extraordinary revenue as NVIDIA, that they had, 19% concentration on a single customer. And so I think you should expect in this industry extraordinary customer size that produces some concentration. In our view, the way to build a customer base of multiple large customers is first to begin with one very large customer and keep that customer happy, meet their needs. Then you're in a position to win your second and third and fourth.
All right. Well, we'll be watching and appreciate the update. Andrew, thank you.
Thank you for making time for me.
You're welcome.
When we come back this morning, Spotify shares falling on some C-suite changes involving the company's founder. We'll talk to Jimmy Fallon today, live ahead of the premiere of his new reality business competition show, On Brand, tonight. Don't go away.
October is traditionally a volatile month for stocks, but that doesn't mean it has to be for your portfolio. We'll talk about investments offering stable returns on today's Market Navigator, which is coming up 2 p.m. Eastern Time on Power Lunch. Stay with us on Squawk on the Street.
About a quarter to the top of the hour. Three of the big movers we're watching today. Shares of HR payroll provider Paychex falling despite some raised guidance as investors eye the impact of a potentially weakening labor environment on already slowing revenue growth and higher costs. Spotify's lower as the company said founder and CEO Daniel Ek would leave his post, become executive chairman. The company's current co-presidents will become co-CEOs. And watch Firefly Aerospace down today after one of its rocket boosters exploded during pre-flight testing at its Texas facility. Company said it's still assessing the impact of that explosion.
Down 20%. The Tonight Show's Jimmy Fallon joins us next ahead of the premiere of his new reality competition show, On Brand, tonight. And still to come, just a few hours away from new numbers out of Nike. Shares lower on the year. We'll tell you what to expect when we come back. Nike reports first quarter results after the close today. Analysts are expecting earnings and revenue to have dropped from a year ago. Shares underwater since the last report. That said, it does still have an average price target 15% higher from here. If you look at all the analysts, 53% of the analysts still say it's a buy, according to FactSet. Today, we're just going to be scouring for any signs of improvement. Elliott Hill, the CEO, has been on the job almost a year now, and there have been some so-called green shoots out there that he's put out from last quarter. For instance, the wholesale orders looking up. They've had some good innovation coming back online, the Vomero running shoes, for instance, and we've heard some positive commentary from some of their wholesale partners like a Dick's Sporting Goods or a Foot Locker lately. So the proof will be in the numbers. I mean, the company's still guided to be declining revenues of mid-single digits for this year as they still have this turnaround effort and inventory to clean up. So any sign of progress should be rewarded because the stock has been under pressure.
Yeah. Meantime, Tonight Show host Jimmy Fallon launching a new unscripted series, On Brand with Jimmy Fallon, premieres tonight, airs twice weekly, Tuesdays after The Voice and Fridays at 8 p.m. Eastern Time. In each episode, creatives will work with a major brand in need of a big idea. Think Super Bowl campaigns, new menu items, or social series with influencers. Brands like Captain Morgan, Dunkin', and Southwest Airlines are set to be featured in the reality competition. And joining us right now is Jimmy Fallon himself from 30 Rock. Jimmy, thanks for being with us, man.
I'm so happy to finally be on your show. I've seen you around the hallways.
Yes, in the cafeteria. You know, as business nerds, I mean, we love this kind of concept, but I'm curious what attracted you to it.
I love shows like this, and I always love advertising and marketing. Since, doing late night and the Tonight Show, we always work with integrations. And I had this idea. I originally sent it to NBC 2 years ago, and they passed on it. But I really pushed for it, and I'm like, I think there's a good idea to this. And finally, we got some brands that wanted to play with it. It's like Shark Tank meets The Apprentice meets Project Runway. So it's like a gamified Shark Tank. It's really fun, and I just love seeing ideas that people come up with, creative people. I mean, this is for people at home who watch commercials and be like, I could do a better spot than that. And so that's kind of where it came from, and I ended up getting a great co-host, Bozma St. John, who is, you might know from The Real Housewives, but she is a marketing genius. She's in the Marketing Hall of Fame. And so she kind of adds some legitimacy to the show, and it's been great. We've had a great time.
I watch her on Real Housewives.
You do? You know her?
Oh, yeah, of course.
She's a genius. I mean, I'm happy about everything.
Style, too.
Yeah, she's very stylish and everything, but I'm more excited about ideas and happy, and then she brings the, okay, here's why this is not good for the brand,
Serious
or here's
idea.
why it's good for the brand. But I think when other brands see what we do with this show, they're going to want to jump on board for season 2. It turned out fantastic, and it's not really my style of hosting, not the Tonight Show, but I got better as the episodes got on. So
What brands do you have on board?
the first episode is Dunkin', and we have Dunkin', we have Therabody, we have KitchenAid, we have Sonic, we have Marshalls, Captain Morgan's a big one, and we have special guests too. There's a big athlete that's going to be on one episode. I can't say his name, or maybe I can. Josh Allen. I'm going to say it. Who cares? What's he going to do?
Exactly.
But it's really, really fun, and it's like coming up with these ideas. And honestly, I was hoping for some bad ideas as well, because I watched all these reality shows like American Idol, and I was kind of hoping for that William Hung moment where it's just, he didn't win American Idol, but he kind of did, because it just didn't work. It was just famous, so I was hoping for a bad idea, and boy, did we get some bad ideas. That's all I'll say.
Though. We are in a world where influencers, I mean, in the old days, you had to be like a creative, right, to have the job and come up with ideas. But now we've totally democratized what a good idea, where it can come from.
Yes, I totally agree with that. I thought that's why it's also a great time for the show, because everybody's on social media. Everybody's worried about their brand and branding, and are they on brand? And so I think this new generation will understand this idea of the show. We have influencers who's playing the game. We have actually professors who teach marketing at a university. We have swim instructors. We have real estate agents. It's all walks of life, and it's super interesting to see everyone's strengths and weaknesses. It's really fun.
Jimmy, it's been a really eventful couple of weeks in late night. I thought you were so eloquent in the wake of Kimmel's suspension. I am wondering how you're thinking about what you can put in a monologue, what it's like being on an FCC licensed avenue of broadcasting right now.
Our show's never really been that political. We hit both sides equally, and we try to make everybody laugh, and that's really the way our show really works. I mean, our monologues are kind of the same that we've been doing since Johnny Carson was doing the Tonight Show. So really, I just keep my head down and making sure the jokes are funny. I have great writers, clever, smart writers, and we just we're just trying to make the best show we possibly can and entertain everybody.
Yeah, I messaged Higgins the other day because you got Taylor Swift on Monday, and then the Demon Hunters. That's going to be a I mean, your booking's been on fire.
I mean, on fire. Yeah, we've been friends with Taylor Swift since back in the late night days. I know her very well. I know her mom very well, but we've always been a fan of hers, and to watch her rise to superstardom, it's been so fun to watch. She's a pro. And I've been friends with her forever, so I'm happy that she chose our show to talk about the new album, Life of a Showgirl. And then K-pop Demon Hunters, that I give credit to my daughter, my 10-year-old daughter who's watching it and said, Dad, this show is so funny. And I was like, we have to have them on because the music is pretty good. And then we talked to Netflix, and they're like, we're not sure if we want to put them on because they're an animated group. They're not really supposed to be humans. And I go, I know, but we can do it in a cool way. And I go, the songs are too good. Golden is a hit. So I'm like, so then they called us back. They go, we'll do it. So we've been very lucky with our bookings, and we're psyched. It's going to be a big week for us next week, Tonight Show.
Yeah, you're between those hits and, of course, the new show. You're going to be busy over the next few weeks.
Yeah, thanks for having me on. I'm excited about this. It's a brand new type of show. If you love those types of business reality shows, you'll like this. NBC is doing a new thing where they're airing a brand new episode Tuesday at 10 and also a brand new episode Fridays at 8. So it does work as a family show too. So everyone get together and come up with your ideas for Dunkin' or Southwest or KitchenAid, whatever you guys got ideas. I want to hear them.
Yeah, and I like the way you've been schooling like the elders on how to find it on Peacock. Just plug in. What do you do?
Yeah, I was like, hey, Dad. My dad was like, Jimmy, your show's not on. It's not on my guide. I go, trust me, Dad. My show is on. It's a real show. Yeah. He was like, it's not on my guide. I go, I know. It will be eventually. This week it's on guide, Dad. So it's a real show. I'm talking, not you, Dad. But yes, Dad, record my show. It's on. It's a real show. It's on tonight after The Voice.
Jimmy, congrats. Always good to talk to you.
You're the best. Thanks for having me on, you guys. I appreciate this. Have a great day.
You too. Jimmy Fallon. Don't miss On Brand premiere tonight after The Voice. Coming up, we are approaching the end of government EV tax credits, but Ford and GM making some moves to soften the potential blow to demand. That's coming up next when Money Movers starts.
was on
Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The best September since 2013, nearly in the books. With stocks entering this year's final stretch, are more record highs likely? We will discuss and debate with the investment committee. Joining me for the hour today, Josh Brown, Joe Terranova, Amy Raskin, and Jim Lebenthal. Let's check the markets here on this final trading day of the month of September. We've got a little bit of work to do today. We are red across the board. Our top story, though, NVIDIA becoming the first ever company to hit $4.5 trillion in market cap. Maybe it seemed like a formality to many, but it is really representative of where we are in this AI story, Josh. Is it not? The stock that you've been in for an awfully long time just continues to march higher. It has had its fits and starts at times, but here we are, $4.5 trillion, slightly above it as we speak. Oh, sorry. Yeah, I was pointing, saying I can't hear him. So we'll keep it on the desk because everybody does own NVIDIA. Joe, you want to take this one while we work on Josh's audio?
All you need to do is just look at the growth of revenue. It's absolutely staggering. $26 billion in 2023, $60 billion. In 2024, $130 billion in 2025. Estimate for 26, 206, 276 in 27, 321 in 28. I mean, that's just historic. It's unprecedented, something we have never seen in the capital markets, and it's the reason behind the astronomical performance that this company is exhibiting.
So the target goes to 210 today from 200 at Citi. On higher AI infrastructure. The target at KeyBank is now 250. We'll go back to Josh Brown as we've fixed his audio. So I don't need to look to the side and do like, what's up with that? I can't hear anything because I'm told now I can.
My bad.
All right. There we go.
Look,
here we go.
I think the big takeaway for investors from this whole era is that sometimes the most obvious way to play a theme is the most obvious way to play a theme. You have to remember, 25 years ago, I was a retail stockbroker, and we were trading the original dot-com boom. And every time a stock would make a huge move, like a Dell computer or a Cisco or a JDS Uniphase or a Lucent Technology, my clients would be like, okay, but what's the next, right? What's the next Lucent? What's the next Cisco? And we would end up in stocks that would obviously blow up, like Ciena, and we would end up in things like Juniper Networks and Sycamore. The old timers watching the show will be chuckling along with me. NVIDIA is still the most obvious way to play the AI build-out theme. Just look at the CoreWeave deal today. It's a $14.2 billion agreement with Meta. It's great for CoreWeave because it diversifies them a little bit away from Microsoft and adds another monster company to their roster of clients in a very big way. But what does Meta get out of this? They're getting access to NVIDIA's Grace Blackwell 300 systems because CoreWeave already has that infrastructure in place and ready to go. All of this benefit accrues to NVIDIA in the end. So it may not go up the most from here relative to other AI plays, but it is the foolproof name for people that want to gain sector exposure or want to gain thematic exposure. And I don't really see that changing. They've got this unbelievable competitive position. We've been talking about it on the show forever because it's true. And everyone's always like, well, what's the next? What's the new NVIDIA? There are other ways to play AI. We've seen other chip companies work out. I've talked about Lam Research on the show. We've had Broadcom, we've had AMD. But in the end, I still think people would be better off looking for the obvious answers and defaulting to them. And if you've done that with NVIDIA, congratulations. We're now breaking into a new range, and who knows how high this one can go.
Well, the question is what to do with it from here. The stock's up 18% in the third quarter. I know you're not. I do find it interesting, Amy, that you're trimming NVIDIA here. Why now?
Well, we've trimmed it. We've owned it since 2014, so we've trimmed it along the way up. Every sale has been a bad sale so far. Obviously, it's making an new all-time
so
high.
Why is this time going to be different?
I'm not sure it will be different. I just think I agree with everything Josh said. This is the most obvious play. We're not selling out of it. But I do think it's prudent, as the position keeps getting larger, to just keep it in line. I do think at $4.5 trillion, you're kind of asking yourself, okay, what's the upside?
I mean, if you had, you know what?
Right.
If Brad Gerstner was here right now, you know what he would tell you the upside is? Because he said it this past weekend with Jensen Wong in his podcast with Bill Gurley. The upside's $10 trillion. Market cap.
Market cap.
That's
okay.
not 10 more trillion from here. But you're talking about a $10 trillion market cap.
A double from here. I think that's a while away. And I think, and with NVIDIA, you do get opportunities to sort of go back in. It hasn't been a straight line up. And I do think you're seeing more articles about what the return on this AI, as Joe said, the trillions of dollars that are going into AI CapEx right now. What's the return on that? When are we going to start to see that? I think you will get people questioning that again on the way up if it eventually gets to 10 trillion, which again, we'll see.
I mean, this remains a key question as Wolf, Jim, talks about AI spending expectations and how it's the biggest driver of market performance. Mm-hmm. So the hyperscalers are tripping over one another to continue to spend tens of billions of dollars towards their AI, their build-outs. And for now, it's great. And that's why Citi has raised its forecast for the hyperscalers to continue to spend the way they are. The moment, and who knows when it's going to be, could be next year, could be 10 years from now, who knows. The moment that there's a comment about spending less in CapEx, is that the moment that everybody says, oh no?
Yes, it is, Scott. But I think to the setup of your question, that we're probably a long way away from that. And it's not just because those hyperscalers have made such bold announcements, really quite frequently and quite recently, but it's also there's other aspects to this that I don't think we give enough attention to, like the international exposure for AI buildouts. Let's not forget, just a few months ago, the President Trump visit to Saudi Arabia, the data center buildouts that are going on in the Middle East. Europe doesn't want to left behind. Asia doesn't want to get left behind. So I really don't think that, when you consider international, I don't think that moment of truth, if we'll call it that, is anytime soon.
Let's look at NVIDIA again, guys. Put it back up for me, please, and take it out at least a year. Just to show you it's not immune to sell downs. We've seen it happen. And give me a year now, if you could, because it didn't happen that long ago. It did. If you look at the 1 year, it was in the spring that the stock had that reset. It got into the 90s.
It did, along with
here we are with a reboot, a double since then.
It did, along with the market, and it really was a source of liquidity, an ATM, if you would, at that point. I think if you're owning NVIDIA, you're asking yourself the question. Jim nails it. I mean, and you brought it up to Jim, Scott. It is all the risk surrounds the spending slows. Okay, how are we funding the spending right now? If you take the Mag 7, obviously NVIDIA is not going to be part of this, and you also put Tesla to the sidelines, you're left with 5 companies who have $480 billion in free cash flow from operations this year to spend on the build-out.
Citi says CapEx across the hyperscalers is going to increase in 26 from 420 to 490 billion, right? So you're approaching $500 billion in spend, and through 2029, from 2.3 trillion to near 3 to 2.8. So you're already looking out to 29. I mean, are we buying these stocks today, trying to guess what 2029 is going to look like? If we're suggesting that a lot of the market performance is, in fact, being driven by the spend, as Wolf suggests.
I would be remarkably surprised if, along the journey to 2029, there is not some form of a stumble, whether it's in the economy, that allows that free cash flow grow not to continue at the pace that we've seen it over the last several years. So I think you have to be prepared for that. It doesn't mean I want to sell NVIDIA. It doesn't mean at the end of that journey in 2029 and 2030, NVIDIA is still not the winner, but you just have to set the expectation. This is all about the ability to generate free cash flow. And there could be some form of a stumble where these 5 companies don't gather
Right.
the free cash flow at the rate they're
And
currently.
remember, AI revenue this year is projected to be about $20 billion. So you're talking about numbers getting to trillions of dollars to spend. Yes, of course, I think the revenue will ramp, but that revenue has to ramp pretty damn fast at some point to justify these CapEx levels.
Scott, let me make the pedestrian comment here that we're about to turn into the fourth quarter. And this is a year in which, I don't know what the exact number is, but mid-20s as a percent of managers that are outperforming their benchmark. That becomes a problem for the other 75%-ish that get into the fourth quarter and say, oh my goodness, end of year is coming. I've got to throw money at the market, particularly if they raise cash during that time that we were talking about. Joe, you said it was a source of fund in April, when we had the post-Liberation Day meltdown. People are going to throw money at the markets. And where are they going to throw it? They're going to throw it at the obvious leaders, the things that are probably the safest.
I just don't feel like that is a layup, to make it such a declarative statement that they're going to throw money at the market. What if they don't? Because
Well,
they
they
look at
don't,
the
that's-
valuations and think what a lot of other people do. Why would I deploy all this cash now when stocks are at record highs and when people say valuations are already stretched? But maybe because I think earnings are going to be really good and the Fed's cutting, so that supersedes any risk that I have on the other side about valuation and putting new money to work at these levels.
You're partially answering the question, but allow me to be a little bit trite here and just simply say that this is the setup that happens in this sort of year every year going into the fourth quarter. Despite what you just said, every year when you have this many managers underperforming, and in particular when you had a whoosh down in almost a bear market in April, that had a lot of people move to the sidelines. They've got to catch up. And I hear you.
But it's trickier when you have such a select group of names
It's been
that
the
have
last
carried
3
the
years.
load
It's been
for
the
the
last 3
market.
years.
Sure, but I don't know. What do you think? I want to go back to Josh in a minute.
I want to stay focused on the CapEx. That's the most important thing. That is the driver. That is the catalyst. Because if the CapEx is not coming from free cash flow, if it is coming from debt, then it's fair to start saying, okay, we're going back to 1999 and vendor financing and all that nonsense from there. If we could, while I'm speaking, pull up a chart over the last month of Oracle, if we could. I want to show what happened at Oracle because it went parabolic, and then people realized, okay, they're doing a $15 billion debt offering. Wait a second. This is not a cash exercise. This is more of a debt exercise, and it's been on the retreat ever since. It's pulling all the way back. It got up to 345 in the day of the announcement. It broke out from 245. Look at it today, 278. It's retracing all of the gain.
Josh, your thoughts?
I just don't agree with the premise, and I'm not saying that you stated this, Scott, but that it's such a select group of stocks leading the market.
Yeah.
I think that's not actually what's going on. Let's talk about financials just for a moment. I know it's a hard pivot, but bear with me. Financials have just recorded the second largest percentage increase in expected earnings out of all of the sectors for the coming quarter. Tech has had the largest. We all understand why. The CapEx growth expectations have been ratcheted higher. What Oracle is saying, now CoreWeave, et cetera, et cetera. We all get that story. If that were 70% of the market's expected growth, okay, I would say, yeah, we got a pretty narrow situation here. But that's not the case. For the financial sector, earnings are expected to come in at 11% year-over-year growth. That's versus a 7% expected growth expectation as recently as June. So in the last basically 3 months, we have decided that the growth rate for the S&P financial sector is going to be substantially higher, and we don't have to wait 2 months to get those numbers. The financials start reporting on Tuesday, October 14th. That's like tomorrow. You're going to hear from J.P. Morgan, Goldman Sachs, BlackRock, Citi, Wells Fargo, Schwab. They're all Progressive. They're all going to tell you the outlook is getting better and better. So J.P. Morgan's one of the largest contributors to that increase in expected earnings for the quarter. Then
Is
you
Jamie
have
going to
names
tell
like
you the
Robinhood.
outlook? You think Jamie's going to tell you the outlook is getting better and better? He was, I think, with
God, I
Leslie
hope
Picker not 2 weeks ago, and said things were slowing, that the consumer's slowing. Now I know people will roll their eyes when they hear it, but also the stocks are up a lot. The stocks are up a lot.
Yeah.
So the bars for some are especially high. Now, what's interesting, there's a note from Deutsche today which talks about that, where they suggest the bar's medium high for J.P. Morgan because it's up 9% in the quarter, whereas Citi and Goldman, you have higher bars, they suggest, because the stock performances have been much better. So the bar now rises.
I agree with that. The point I'm making is not necessarily what the stock price reactions will be. I think when we get that affirmation from the largest S&P financial sector components that things are good and getting better, that's good enough for a market-wide continued rally, which is what we want to see. So as much as we're seeing fireworks in the technology sector related to this AI theme, you also have stories like Robinhood, which is trading like it's an AI stock. You've got banks making new, not just 52-week highs, but all-time highs. You've got insurance stocks like I own Berkshire Hathaway B shares. So as an example, that stock sat out 6-7 months in the penalty box, and that one's now trending higher again. So it is not a situation where we're all just reliant on a continued run in NVIDIA and Oracle and Microsoft. That's not the tape right now. The tape is way better than some people are giving it credit for.
I got you. Morgan Stanley's Katie Huberty says the quote, everything rally will persist for now, but given the rich asset valuations, they suggest own quality, which is obviously extends far beyond the mega caps. We totally get it. Major averages in this quarter, we should show you just to give you the scorecard really of where we are. In Q3, the S&P up 7%, NASDAQ's up 10.5% in the quarter, the Dow up 4.5%, and the Russell, Amy, is up 11%. Yep. So as we're talking about, okay, earnings are going to be good, Fed's embarking on rate cuts, and maybe the broadening trade's going to work out, does the fourth quarter end up looking a lot like the third, or no?
I'm not sure at the fourth quarter. I mean, I think the rally does continue. I don't think it continues necessarily at this pace.
Everything rally.
But it's not only the U.S. Ex-U.S. is doing even better. I mean, I've spoken about Santander on this program many times. It's up 130% year to date. So like NVIDIA, as to Josh's point, isn't one of the best performing stocks in our portfolio this year. It's Franco, it's ABB, it's IonQ. I mean, it's a broad, I have almost over half the portfolio up over 20% year to date. There's a lot of stocks that are working really, really well, including the financials and Goldman and JP Morgan, which, as you'll know, I just trimmed as well and added to Berkshire. But there's just a lot of good news now baked into a lot of these stocks. That we've had major moves. Goldman's up 70%.
Is that why you trimmed Goldman and JPM?
Yes,
because of the moves that they've had?
Yeah, over the last 52 weeks, Goldman's up 70%, JP Morgan's up 50%, Berkshire's up 10%, to Josh's point. So we took some out of those two names, put it into Berkshire. But we also own a lot of Japanese banks that are doing really well.
What do you make of the way Berkshire's traded since Mr. Buffett made the announcement he did?
I don't think it's that surprising that it took a pause after he made the announcement, but I really think Berkshire is like insurance. I mean, it's insurance literally, but it's also insurance if you do get a slowdown in the economy, if you do get the market rolling over. They have a huge cash pile that they could put to work pretty effectively. I think the team in place is totally qualified to do that.
I think everybody's trying to assess where the best places to be are for the remainder of the year, whether it's sector or individual names. And you know, some firms on Wall Street are out with their own lists today. Some of the names may not surprise you. For example, UBS has their highest conviction calls. Okay, Amazon's on the list. Everybody owns Amazon on this show. I think it's interesting. Disney is on their list. So if people looking for names outside of the Mag 7, well, here's your Disney.
Fireworks.
Yeah, well, Disney had a great start to the year. It's kind of consolidated here. I almost said sputter because it's on the border between consolidating and sputtering. It needs to get some mojo back. The only thing that's going to do that is earnings and the sign that streaming is picking up more and more steam as linear declines. And streaming should be picking up steam, not just from the regular content, but from ESPN. Obviously, the theme park's doing well. And I think what we're talking about right now...
You didn't even talk about Succession, which is the biggest issue hanging over the whole story.
Listen, it is a very big issue. I don't think that it's make or break on the stock. I think it's important. I'm not saying that, but let's face it. There's some very talented people behind Mr. Iger. I mean, there's Josh D'Amaro. I might have got his name slightly wrong. Excuse me. The theme parks. There's Dana. I'm sorry, forgetting her name. The TV and film. Thank you. Sorry. There's a very talented bench.
Note to self: don't mention names if you don't know the names.
I got half of it right. Give me some credit there. Also, I knew with a good team like this that I'd get back up. This exactly is what I'm talking about. If you got a good team, you got backup.
Yeah. Like note to people on a debate, for example. Don't make a list if you can't remember the list. You know what I'm saying? You know what I'm talking about.
We do.
All right, AppLovin is on the list. Joe T.
It is, and I talked yesterday on the show about the skepticism that I still think is built in the stock price in the analyst community. The price target way below the current price at $700 today. In addition to that, the ad platform continues to grow. They're delivering on the revenue growth. There was a point several weeks ago I was skeptical that this could continue. Thanks heavens that Joe T is a rules-based strategy kept us anchored into that position, didn't allow me to make a foolish move.
Snowflake is on the list.
Snowflake, a software name also related to AI, getting that bump, had done really well year to date.
Well,
very, very expensive.
It's differentiated itself from some of the other software stocks in the conversation over whether, AI is going to kill software.
Right.
It's definitely hurt some software stocks, not this one.
Right. No, you need Snowflake to organize your data and to make sure that you can use AI. So it has differentiated itself, and it has a unique position. You're paying for it, though.
MasterCard?
Yeah. Listen, MasterCard's been one of our longer holdings for the better course of the last 4 years. Now you're hearing both Visa and MasterCard enter the conversation as it relates to stable coins. That might be a tremendous opportunity for two companies that are well diversified in their model.
Do I have any interest in Wealthfront, the company filing for an IPO? Obviously in the fintech space. We've talked about it on this program before, and I think we did numerous times, this sort of robo-advisor, automated investing almost. Josh, I know you have thoughts on this. And so now the company's going to go public, and we've discussed this with you before, both the concept and the company.
They have to go public. They have VCs trapped in this stock for 13 years. This marketplace was not supposed to develop the way that it did. If you rewind back to the 2012, 2014 period when these robo companies first came along, they were very good at what they did, but they were a little bit too vocal about it. And what ended up happening was Vanguard and Schwab decided, hey, we could do that too. And then Merrill Edge digitized, and then Fidelity. And of course, there's Betterment out there as well as the other standalone. And what ended up happening was robo-advice became kind of this commodity offering that everyone has. SoFi has it too. Robinhood has it too. So there's really nothing that they do that's unique. They did have a head start by virtue of how early they were founded, but that really doesn't matter anymore. This is basically just a marketing CAC business, like how much money do I have to spend to get my next 1,000 clients? And that's never a great business. I think it's notable that Wealthfront tried to sell itself to UBS. UBS preferred to pay the breakup fee and get itself out of that deal rather than consummate it. I don't know what they saw that spooked them. So now a couple of years has passed since then. And finally, you have the type of tape where Robinhood's making record highs, SoFi's exploding higher. It's a tape that's more hospitable to these types of fintech investment sort of platforms. So I think it's great timing to be selling it to the public today, just because people want these types of companies. I don't know that means it's going to be a great investment once it comes out. So this is the type of thing where I'd rather just be a spectator and we'll all find out together how much appetite there truly is for a business like this.
Yeah. We should also note S&P has taken a move higher here. We were uneven as we came into the session, but there's your move. Healthcare, having a good day. You obviously have the announcement with Pfizer in the Oval, the CEO, Albert Bourla, with the president there on that drug pricing plan. So that stock's doing quite well, up 4%. Haven't seen that a lot, so that space is doing well. The AI trade working especially well. We'll bring it full circle to how we started with NVIDIA above $4.5 trillion for the first time ever. First time ever a company has reached that level in market cap. NVIDIA's up another $5 today. That's just shy of 3%, but it's an AI story, very much so. Chips are working, the power names are working, Vertiv, Eaton, GE Vernova, for example. are all on the move and helping this market look the way it does. Some 24 and a half minutes into our program. We'll take a quick break. Coming up next, Josh Brown. He just made an out-of-the-world trade. Did he say that? I guess he did. Somebody said that. We'll tell you about his new buy. We're back after this. All right, let's talk about some of these moves we have. I teased Josh with a new buy. So it's Planet Labs. Give me more.
Okay, so I have a couple of moves, and they're all related to something that I think is going to be a really big investment theme next year, which is the low-altitude economy. Basically, the low-altitude economy is anything that's sub 3,300 feet high in the air. So it's drones, and it's satellites will control a lot of the data that enable that, although satellites are obviously in orbit in space. But mostly, it's going to be air taxis. And there are a lot of catalysts coming up over the next 3 to 6 months that I think have the potential to really get people excited about the space. Planet Labs is basically setting itself up to be the data provider. It's a network of satellites, but they'll be selling their data to all of the air taxi companies, of course, in addition to military, in addition to forestry and meteorology. So they've got these next-gen satellites. It's this constellation of satellites that they call Pelicans. And this is a real business. It went public as a SPAC in 2021, spent 3-4 years basically out of sight, out of mind. But now they're in a position where revenue growth is about 20% quarter over quarter. They did like $70-something million in revenue last quarter. When they reported on September 8th, the stock absolutely exploded. I'm in a small position here in PL. It's very speculative. The company is not going to be GAAP earnings positive for a couple of years, although they just had 2 straight quarters of non-GAAP cash flow positive. So they're trending in the right direction, and I anticipate being able to buy this stock lower over time. So this is just an initial starting position here in Planet Labs. Do you want me to talk about the other two, or you want to do that later?
Well, hang on a second. Do you have a comment?
I have a question.
I think Joe has a question about Planet. Hold on first, and then I'll prompt you on the others.
Josh, on Planet Labs, are you factoring a takeout possibility with Alphabet? I think Alphabet has 11% of the shares outstanding.
Yes. Alphabet owns 10.5%. I don't believe that they own it with the intention of buying it because they've had that position. Of course, anything's possible, and I'll be the last to know if that's going to happen. That being said, look, I like the data business. I like it in finance. I've pitched Moody's on the show. I've pitched S&P Global Indices. I think like when you think of businesses that have the potential to scale and have really high margins, data in every segment of the economy almost always works. That's essentially what this business is. They're not sending rockets up into space. However, it's very high tech. The satellites they have all have these NVIDIA Jetson AI chips on board, and they're generating some of the highest quality imagery and data. And the amount of customers who are going to need to buy this information from them is rapidly expanding thanks to the low altitude economy taking off next year. So, Joe, I'd be happy if they just remain the primary data provider to that theme. I feel like that would be good enough. If Alphabet's feeling froggy and they want to leap and take a run at this thing, that's okay too. But I have absolutely no need for that, and I don't know anything about it.
All right, so the other ones, you bought more Joby, just in the theme, the low altitude economy is how you framed it. You bought more Joby, and you bought more Archer Aviation. Go ahead.
You know what? I'm worried that these things are going to go, and I'm not going to be big enough in them. So I added 50% to my position in each one. These are the most speculative stocks in my portfolio. I want to make it very clear. We're talking about literally flying cars. So people who are risk averse, people that can't withstand 30, 40% drawdowns in a stock, do not get involved with these stocks because they're going to be volatile. But if we're all talking about the low altitude economy next year because these companies achieve FAA certification to begin eVTOL flights, that's electric, vertical takeoff and landing, meaning somebody in Midtown Manhattan goes to the roof of the building, gets into one of these 4-passenger air taxis and can be taken to the Hamptons or JFK or to the Ryder Cup out on Long Island in minutes. Like, if that's where this ends up going, and I do think it will, I think these stocks are going to be like owning Tesla like in 2013, 2014. So it's really speculative. It's not a huge part of my portfolio. The way to think about Joby is they could be like the Boeing of the low altitude economy. They're only producing a couple of vehicles a month at this point. It's going to be a long time before they're making hundreds or thousands, but Toyota owns a big chunk of Joby. Toyota is their manufacturing partner. Toyota makes 1 million out of the 10 million automobiles that are manufactured every year globally. Toyota is as good of a partner as you can get, and they have a vested interest in seeing Joby succeed. In the case of Archer, their vehicle is called the Midnight. They are also testing with the FAA, trying to achieve FAA certification. They're not as big as Joby. I don't think they're as far along. It's too early to guess which one of these companies will win, so I own both stocks, Judge.
Okay. You're looking at me like,
well,
you keep looking over like.
There's two ways I want to react, if you would allow me to. There's two ways to think about Josh's ownership here in the VTOL, and they're similar companies. Joby is further along for FAA certification, much further along than Archer is. The other side of it that you have to factor in, and I'm sure Josh is, significant cash burn is involved in these businesses. And what does that mean? That means to get to the end point of FAA certification, you're probably going to see some equity dilution at some point.
Okay, let's get the headlines now with Bertha Coombs.
I think that's right.
Hi, Bertha.
Hi, how are you? Florida Governor Ron DeSantis and his cabinet unanimously voted today to donate land next to the Freedom Tower in downtown Miami for President Trump's presidential library. The land is currently a parking lot that, until last week, belonged to Miami-Dade College. According to the Miami-Dade County property appraiser, the parcel is valued at more than $67 million. Polish authorities say they arrested a Ukrainian diver in connection with the 2022 Nord Stream gas pipeline explosions in the Baltic Sea. German prosecutors said the suspect was, quote, strongly suspected of being part of a team that planted the explosives on the pipelines. In August, Italian law enforcement arrested another Ukrainian man on suspicion of helping to coordinate the bombings. And Versant, which will become our parent company after a spinoff from Comcast, signed an 11-year media rights deal with the WNBA today. Versant says the agreement will start in the 2026 season and will include at least 50 WNBA games annually. The agreement expands on a previous deal the WNBA had signed with USA Network last year. Go WNBA.
All right. Bertha, thank you very much. Bertha Coombs. Coming up next, Mike Santoli. He's back with his midday word. We're back. Senior markets commentator Mike Santoli joins us now for his midday word. Final day of a good quarter for stocks. Not what the calendar suggests is supposed to happen, but that's the kind of market that we've been in for the last few years.
Yeah, for sure. You have to give the market the benefit of the doubt when it does defy the negative seasonal tendencies. I think it's coming to the end of the third quarter in an interesting little zone here where you have a little bit of below the surface weakness and some stocks settling back. The index is holding up just fine. We haven't been able to have really a proper pullback. Interesting. You can squint and see the signs of a little bit of a softening up of growth expectations within the market today in some of the consumer areas. But in general, we've managed to keep it going. We have the combination of, this kind of weak jobs number. It's going to get the Fed in play a little bit more. On the other hand, a lot of leading indicators and expectations of a reacceleration out of this, and then the debate around the CapEx stuff. And the fourth quarter ramp is a universal expectation, even though it only happens 75 to 80% of the time. So I think all that blended together has sellers kind of not in any hurry. But on the other hand, you might have to go through a little bit of static before you get to that sort of all clear for the year-end run.
It'll be interesting to see whether the activity in the fourth quarter matches the third in terms of performance. I'm looking at the majors in this quarter, and the Russell was the outperformer barely over the NASDAQ. That may end up being a neck-and-neck thing by the end of today, given where the price action in the market is. But nonetheless, I mean, you had a nice broad market in Q3. Will it continue in Q4?
It was broad in the sense that it was not exclusively one little narrow slice of stocks. I think the whole breadth thing is completely about how you measure it. You know, the percentage of stocks above any given moving average is not that strong right now. If you look at the daily tally of up versus down, it's mostly hanging in there. It looks fine. Sector stuff is depending on what your start date is. So I don't know that there's a way to call it clearly. Obviously, they try to execute the Fed rate cut playbook. You know, we basically have 125 basis points of cuts from the peak, and we haven't had a recession. So in theory, that should be supportive of the market, and it has been so far.
Yeah, I mean, the market's definitely betting heavily on October and then in December. Mike, thanks. I'll see you on Closing Bell. Mike Santoli. Straight ahead, Amy Raskin has some more moves to tell you about, and we will coming up. We have several moves from Amy that we need to get to. All right, so you bought more Visa, which was reiterated outperformed today at Mizuho. $425 is the target. Talk to me.
Again, we sold some of our JP Morgan and some of our Goldman Sachs, so this is sort of shifting our financials weight. It's a little bit more of a defensive name in my view. It's cheap compared to its own history. It has, we think it's really well positioned, obviously high barriers to entry. Joe spoke about MasterCard earlier, but we also like its international exposure. There's a lot of stimulus overseas, so Visa has exposure there.
Okay, Regeneron's been disappointing.
Regeneron has been terrible.
It's almost half off its 52-week high.
Exactly.
And it's down 20+% this year. You bought more.
Yeah, we did. Almost everything that could go wrong for this company has gone wrong. It's cheap relative to its own history, and we think the science isn't broken. That's a big point. They're expecting to get FDA approval for their high-dose Aaliyah in November. Hopefully that comes. So we do see a few catalysts out there. Again, it has not worked. It's been really, really disappointing. We've had a lot of names that have worked, so we're taking some profits from what has worked and putting it into Regeneron.
Okay, a lot of people made a lot of money on IonQ.
Yeah.
Right? When did you first talk about it? Do you remember?
October last year, which is really interesting because this is my third trim, and I considered waiting till mid-October of this year so I could make the gains instead of short-term gains, long-term gains. But the stock has done so well. We first put it in at $13 last October. It got up to 70. A lot has gone right for this company. They've gotten a lot of great talent, done some great acquisitions. The company's made more progress in 12 months than I expected. But the stock also, is up almost, 4 times.
It's 600% winner.
Exactly.
Since you first
since you first
did it and you first talked about it on the show. Unbelievable.
So we still have a position. We're still there, but just keeping, it's very volatile, speculative. So we're just keeping the position size small.
Let's do another one of yours. You bought more Williams companies.
Right. So this is a new stock for us, Williams. It's a pipeline. They control 1/3 of the natural gas in the country, but their contracts are fixed costs, so they don't have commodity exposure really. We just think it's a well-positioned company going forward. It hasn't run like some of our other commodity-related or gold-related names, so we added it to the portfolios. We like it long-term. I don't think this is a blockbuster double. It's not an IonQ sort of name, but a solid performer.
Okay, thank you. We'll see what's up with that in the months ahead. Coming up, Spotify is on the move today. We'll tell you why shares are under pressure next. Got some stocks on the move today that have ownership on the desk. CRH is one. Company upped its outlook today. You went to the investor day. I did. Right?
Did. Great news coming out of there. They're raising their guidance, or at least above what estimates were. This is a company that had more than solid performance. 58% annualized return over the last 3 years, 30% over the last 5 years. It's up 30% year to date. Now, does it have more to go? Yes, and here's why I say it. It's the biggest paving, aggregates, cement company in the world, bigger than competitors Vulcan and Martin Marietta, and yet it trades at a 33% discount on earnings multiple to those companies. There is opportunity there. Why does it trade at a discount? Because it's basically an international company that only recently, in the last 2 years, listed in the U.S., and that's the opportunity. It should accrete to the same multiple as Vulcan and Martin Marietta. There's much more to go here.
Okay, Spotify's founder, Daniel Ek, is leaving the CEO job. They're going to have co-CEOs. The co-presidents currently are going to take those roles. Joe T owns it.
It
right?
does, and anyone that has been watching the show for the last several months know I'm a strong advocate. I believe in owning this company. I think it's the equivalent in music to what Netflix is right now in streaming. It feels very similar to when Reed Hastings left and appointed Greg Peters and Ted Sarandos as co-CEOs. Similar model now where you have a founder stepping aside from Spotify. I understand the kind of challenge that the market feels today from it. That's why it's down 6%, but I'll take the other side of that.
Well, if you look at the chart year to date, it's had a big move. It got downgraded today from Goldman. It did. Right, to neutral from buy. They look at the chart and they say, well, risk reward doesn't look so good from here. They did bump the price target up. They're not naive to the fact that the stock can continue to go up from here. They just don't like the risk reward given what that chart shows.
That's fair, but I think what you're up against here, if you own it, is less about a price correction and more about a time correction, more about kind of running sideways to lower until you could see some growth catalysts reemerge.
All right. Nike reports after the bell, oh, how the mighty have fallen. Amy, you sold it in May. Joe, you sold it in June. It's coming off its 5th straight negative week. So you obviously have a new CEO, and I guess investors are wanting to see results. It's down 8.5% year to date. What gets you to buy the stock back?
More rational competitive landscape. I mean, you saw what happened with Lulu last quarter. I just think there are just too many players competing for too small of a market right now. So I'll listen to the call. I mean, it's a huge market. It's a huge market, but Nike used to own this market. I mean, it used to be Nike, Adidas, Puma, and now you have a lot of new startup sneaker companies, a lot of new brands out there. I mean, even just watching the U.S. Open, there were new brands every other minute. So I just think Nike has a harder road than it used to have.
All right. We'll come back with final trades next. Full house at 3 o'clock on Closing Bell. Adam Parker, Courtney Garcia, Chris Heisey, Rich Saperstein, and Rick Heitzman. I hope you'll join me then, 3 o'clock Eastern. Josh Brown, your final trade's what?
Sticking with NVIDIA, not selling.
All right. $4.5 trillion in market cap today. It is a new record high on this final day of the quarter. Farmer Jim.
Lockheed Martin, it had a rough summer, but it's really making a nice run here. It's up 10% for the month. It's in positive territory for the year, and we understand what the drivers are. It should continue.
Okay. Amy Raskin.
Regeneron, we talked about it earlier. Maybe some of the healthcare, healthcare might be turning a corner now that we got the news out about the pharma pricing.
Well, today, certainly leading the way after the drug pricing plan with Pfizer announced in the Oval Office with the president. Joe T.
Amphenol, been in Joe T since inception of November of 2020, continues to just work and move higher.
All right, well, it is moving higher yet again today. I'll see you at 3 o'clock on Closing Bell. The exchange is now.
Thank you, Scott. Welcome to the exchange. I'm Melissa Lee along with Mike Santoli. Stocks marginally lower right now, on track for an unusually strong September and a strong quarter. The Nasdaq leading the gains, about 10% since the start of July. The S&P up 7%, the Dow up 5%. This is the government will all but certainly shut down at midnight tonight.
Well, treasuries are firmer after rallying to start the week. Yields down a few basis points at the short end of the curve as that October Fed rate cut gets fully priced in. Oil down again amid headlines that OPEC Plus is considering an increase in oil output. And speaking of energy, we're keeping an eye on Oklo, one of the companies the Department of Energy just selected for a new nuclear project. Energy Secretary Chris Wright joins us live on the heels of that announcement and on continued questions about AI energy constraints.
Yeah, but let's talk about this market. I mean, we've been talking about the shutdown and the impact on the markets for so long. You talk to market participants, generally they are willing to look through. So this sort of pause in markets right now, I don't know if you can attribute that directly to a shutdown or concerns.
Unlikely.
Yeah.
Unlikely the outright concern about it. The longer it lasts, the more it becomes relevant. Working with less government data flow could become an issue. Looking below the surface, it's a little heavy, to be honest. You have more stocks down than up. A lot of the consumer cyclicals are taking a break. The JOLTS data, not great. A little bit of a downside on some of the PMI. So I don't think it's really a growth scare, but it definitely shows maybe some of the horns being pulled in.
Yeah, and we were chatting before the show, and you're mentioning the consumer finance stocks in particular, the Affirms, the SoFis, Cap One Financial, and you got to wonder if there's been the concerns about the bankruptcies of First Brands as well as Tricolor. You also had the CarMax last week, the commentary about the lower-end consumer being more inclined to be delinquent at this point, and so you have to wonder if these pieces are sort of falling together to paint this sort of mosaic of a troubled consumer, some trouble under the surface in credit.
It feels like a soft patch in terms of general consumer enthusiasm. Consumer confidence numbers today, the jobs hard to get versus jobs plentiful survey response was like pre-recessionary. I mean, it's pretty negative. So, again, we have this soft patch in the labor market. Everyone thinks the economy is going to pick up from here because of the Fed rate cuts. So a little bit of a stutter step, if nothing else.
Meantime, we are watching shares of CoreWeave. They are surging today after signing a $14 billion AI infrastructure deal with Meta. The announcement comes just days after CoreWeave expanded an agreement with OpenAI. Our next guest is bullish on the company, initiating coverage of CoreWeave with a buy rating, a $175 price target earlier today. Joining us now, Amit Daryanani, Senior Managing Director at Evercore ISI. Amit, great to have you with us. It sounds like you started your initiation prior to this deal being announced today with Meta, but in the context of CoreWeave, one of the bearish sort of pillars of the bear argument had been customer concentration. And this, along with the OpenAI deal last week, that seems to sort of answer that to some degree.
It absolutely does, right? I mean, at this point, you have the complete M&M. You have Microsoft and Meta over here, and hopefully you have other customers as well. So Sweden's the story a lot more, if you may. I do think fundamentally what's happening with them right now is demand for AI infrastructure is far in excess of what supply is. And, CoreWeave is positioned to benefit really, really well from having, one of the largest independent GPU clusters, 250,000 plus GPUs, that a lot of customers beyond just Microsoft and Meta, I would argue customers like Google and others could look at this as well to get incremental demand, because that's really what the shortage is for right now. Is there's not enough supply to go around for all these companies.
Within your note, Amit, one line stood out to me, and that is, while we can see there are a wide range of outcomes and the stock will be volatile near term, there's a higher probability that CoreWeave will be able to sustain and scale their differentiation. et cetera. I'm wondering if there are many notes where you actually think about things in a probability, or if that's just the nature of this sort of business.
Melissa, I'd say it's really the nature of this business. And, I will concede that there are a range of outcomes. Near term, it all looks good. And certainly the stock is reflecting that. But eventually, right, I mean, the two things that I think people will have to wrestle with longer term on CoreWeave, one is CoreWeave makes a fundamental assumption in their entire business that the useful life of a GPU is 5 to 6 years. Is that truly going to hold up, or is it going to be much lower, right? And depending on how you end up there, it has a huge implication to the business model. The second will be, is this business going to keep doing well in a time when supply is limited, demand is great, and the minute supply for GPUs, for example, improves, is there still a value proposition, a differentiation for CoreWeave, right? And so I think those are two things that could trigger a wider range of outcomes at CoreWeave more than what we typically see in companies.
Yeah, the useful life of a GPU is a pretty key variable, it would seem, because one of the criticisms of the general business model is, look, these are very fast depreciating assets, and you obviously have to keep kind of refreshing the capital spend to keep up. So obviously, if they can prolong the life, it's very positive. I guess my bigger picture question, I mean, is this the part of the food chain in the AI ecosystem that they're going to preserve returns for? In other words, are they going to continue to get the benefit of the economics when their customers on one side, NVIDIA, and then some of the cloud platforms and all the rest of it, it's capital intensive and they're kind of a middleman?
Oh, today, yes, they're absolutely a middleman. And, middlemen, in fairness, make a lot of money when you have supply-demand imbalances, which presumably you have right now. Over time, though, the differentiation has to be less about I have GPUs and no one else does. It has to be more about I can either help you run these GPUs more efficiently than anyone else can. I would argue there's some data that says the MFU, the model flop utilization, is better than the legacy hyperscalers. The second part will be, can you add more software, more services to differentiate your portfolio? And perhaps customers will pay you $2 an hour for your GPU, but they might pay you extra money, extra pot of dollars for the software you can provide on top of it that perhaps makes it a much more sticky platform. Eventually, that's where you need to end up, is a software-driven platform versus just a hardware differentiation that they have right now.
And in terms of the competition, I mean, how much of a moat does CoreWeave have versus the other neoclouds out there like an Nscale or a Nebius? And at what point, if any, at any point, does price competition start to come in? I mean, Mike had mentioned the notion of middlemen. Middlemen don't usually have the upper hand when it comes to setting price.
They absolutely do not have an upper hand in a normal scenario unless supply is limited, demand's high. Then they do have some pricing power. The differentiation for CoreWeave today, in fairness, would be, against legacy hyperscalers, this is built from the ground up to be an AI deployment tool versus others that are perhaps built for general purpose deployment. So there's a hardware differentiation here against legacy hyperscalers. Now, against the neoclouds, I would say the big thing that differentiates them is scale. They are running a 250,000 GPU cluster today. I believe that's the 4th or 5th largest GPU cluster out there in the world. None of the neoclouds really come up close to that scale or size. And another part is they do have this almost preferred nation status with NVIDIA right now. And one of the interesting parts is NVIDIA signed an MSA with CoreWeave, essentially saying, we will buy any unused capacity you have up until 2032. That almost gives them more ability to go up and ramp up capacity more than perhaps the other neoclouds can.
All right. Amit, great to speak with you. Thanks. Amit Daryanani.
Thank you.
All right, our next guest says the AI trade remains on solid footing and hyperscalers are generating enough cash flow to invest in AI with one hand and return cash to shareholders with the other. Joining us now is Vinu Krishna, head of U.S. equity strategy at Barclays. Vinu, great to catch up with you. So I guess there's no real doubt that the Microsofts and Amazons and everybody else certainly have the free cash flow of the Metas to do all this at this point. Does that speak to whether they're going to be getting a proper return on all the investment and whether investors will continue to reward them for it?
What I would say is that they are already monetizing it. So in their core businesses, which ranges from e-commerce to cloud services to a whole bunch of advertising and things like that. They're already deploying and monetizing it. For example, the software stack itself, where their core businesses reside, productivity improvement over there is about 30-40%, right? So, and that's the reason why I think if you look at big tech, which is obviously bigger than just the hyperscalers, but a small group, you saw their net margins actually improve almost 200 basis points, in the last quarter compared to now at this point in time.
To what degree is your call on the way the overall market is going to go and how earnings are going to track dependent on this one dynamic? It just feels like a very corporate CapEx heavy moment in the cycle as other parts of the economy maybe take a breather.
Yeah, that's a good point. That's something we've been pointing out for a while, that this is a highly bifurcated market. And what's working right now is the bigger, not just big tech, but tech in general and financials. Outside of that, to your point, a majority of sectors are facing various degrees of pressure on operating leverage and hence pressure on margins on the core businesses, as you saw in 2Q. But as far as tech is concerned, and broadly the economy to a large extent, because it's been so important even in contributing to economic growth, is that for the foreseeable future, which means call it 12 to 18 months, it does look to us that the capital spending cycle remains intact. They're generating a lot of operating cash flow, like you said. They have a lot of flexibility because almost 50% is being used for buybacks. But down the line, I think eventually is when one has to think about the potential for what if things slow down. And that's what we did in our recent research.
And one of the scenarios, I thought it was very interesting. You actually said, what if data center CapEx declines by 20% over the next 2 years? What would the impact be on EPS, on earnings for the S&P 500 and valuations? You came to the conclusion that it would be a bigger hit to earnings as opposed to valuations. Can you walk through what you found and what that differentiation would be? Because it did seem like the hit to earnings would be very small, but I would think from a market psychology standpoint, as you say, that would really hit valuations much harder.
Right. I think to understand this AI cycle, what's interesting is that the AI narrative or the theme has spread way beyond hyperscalers. In fact, our view is that hyperscalers are somewhat de-risked. Their valuation multiples have been coming down. In other words, they've been earning into their multiples. But the trade has spread to parts of energy, parts of industrials, utilities, and other parts of tech, the component supplied, like networking gear. So I think that is where we certainly see a risk. And to your point, when we did the bottoms up work with our analysts to look at the impacted areas, call it about roughly 80 stocks, the earnings impact is about 3 to 4%. But like you noted, what we felt is the risk is much higher on the valuation front, call it 10 to 13%, because that is where if you have a pullback in CapEx, it's not just the affected companies, but also the hyperscalers to some extent, which can see some moderation in multiples. So when you put those two things together, you're looking at roughly a 15% plus hit to returns for equities should there be a slowdown. And by the way, the 20% number on one metric, it looks quite draconian because the consensus view right now is for a 30% compounded growth in CapEx over the next 2 to 3 years. So 20% is a pretty sharp pullback over the next 2 years. On the other hand, we did find at least 2 precedents. If you saw how Amazon overbuilt its warehouse capacity after COVID and then pulled back, that decline was roughly 18-19%. Similarly, as you know, when Facebook went towards the metaverse for a bunch of years and then pulled back eventually and turned course, that also was accompanied by a roughly, call it 19% pullback in CapEx. So that's why in a bear case, which we thought is prudent to look at in this market where everything seems to be so hunky-dory, we picked with a number of 20%, and we concluded that there is some risk. The one point I would note on that is this scenario doesn't take into consideration what if there is broad macro pullback.
Mm-hmm. Yeah, obviously that would be another layer to it all. Vinu, thank you so much.
You're welcome.
Vinu Krishna.
We're less than 11 hours away from a federal government shutdown after congressional leaders were unable to strike a deal to pass a stopgap funding bill. Eamon Javers is at the White House as the latest on whether we could see an 11th hour solution
It's looking less and less likely, Eamon.
Yeah, Melissa, that's right. There's a real sense of resignation settling in here in Washington, D.C. President Trump was just asked a short time ago in the Oval Office if it's inevitable that there's going to be a government shutdown. He said, you know, nothing's inevitable, but it's starting to look more and more likely. Senate Majority Leader John Thune was on CNBC earlier today, and he was talking about this idea of maybe some wiggle room in negotiating with Democrats over an issue on tax credits, but he said he doesn't want to negotiate with Democrats on the terms that they're demanding. Here's what he said. Democrats, Hakeem Jeffries, also, for his part, the leader of the Democrats in the House, blaming Republicans. Here's what he said. Tries to pin the political blame on the other. And the question is going to be, you know, what does the American public think about this? If we do get to a shutdown, where will that political blame game play out? And that is, of course, TBD, Melissa. Back over to you.
Yeah, where would the pain be felt, if any, and who gets the blame for it? Eamon, thank you very much. All right, let's stay on Washington. With the Department of Energy naming Oklo as one of the 4 companies that will be a part of the DOE's new pilot program to build advanced nuclear fuel lines. This comes just one day after the administration said it would open 13 million acres of federal lands for coal mining, which moved those stocks. Our Morgan Brennan joins us now with Energy Secretary Chris Wright for a CNBC exclusive interview. Morgan.
All right, Mike, thank you. And Secretary Wright, it's great to speak with you today. Welcome.
Thanks for having me, Morgan.
So
I'm here at Brookhaven National Lab on Long Island.
So let's start right there, because you are at Brookhaven National Laboratory. You just put out some news a little while ago about plans to work with and partner with more companies around nuclear fuel. What does that entail?
Yes, we've got to stand up the whole supply chain for nuclear in the United States. We really want to get nuclear going again. We've got to have reactor technologies here. We've got to have uranium enrichment, and we've got to have the ability to fabricate fuel that's going to be used in these next generation reactors. So 4 partner companies were picked that have technologies and interest to invest capital in nuclear fuel, and we're going to give them grants and work with them to stand up the nuclear fuel cycle right here in the United States.
I think a lot of Americans would be surprised to realize just how reliant the U.S. is on foreign sources of nuclear fuel, including Russia. So how quickly can you bring all of this capacity online?
Nothing in nuclear moves super fast, so we are going as aggressively as we can. It's going to be 2 or 3 years, not 2 or 3 months. I wish it was 2 or 3 months. But that we have just stagnated our nuclear industry for decades. I am highly convinced the Trump administration and our Department of Energy is making a rapid pivot. We're going to have shovels in the ground and things under construction. But unfortunately, we and Western Europe and East Asia are going to be dependent upon enriched uranium from Russia for 2 or 3 more years. I wish it was tomorrow that we didn't need a drop of it.
I mean, there's some reports circulating here in the last couple of days that the administration is considering a proposal to divert plutonium, which plays such a central role in U.S. nuclear weapons stockpile, which the Department of Energy also oversees, to private sector applications as well. Is there any veracity to that? How to think about it?
There is. You can use plutonium as a fuel in these, particularly these next generation reactors that use HALEU, a more highly enriched uranium. Of course, it's critical for our stockpile, but we have surplus plutonium. So that's a very real possibility. We're looking at anything we can do to accelerate the construction of nuclear reactors and to put new power on our grid. Nuclear is the second largest source of U.S. electricity, and it works 24/7, whether the wind is blowing or the sun is shining. So this is electricity that can drive down electricity prices and help us lead the AI race and reindustrialize our country.
It's interesting. We've seen a lot of investor appetite, both in public and private markets, around nuclear and other types of new technologies. I'm actually at the UP Summit here in Bentonville, Arkansas, and you have startups that are focused on fusion energy here as well. Billions of dollars in venture capital going into that possibility for the future, too. How to think about the mix, especially when it comes to working with states like New York, where you are right now, and where legislators are actually mapping out their own nuclear strategy today.
Yeah, so we'll do everything we can to help New York and any other state that wants to develop new nuclear capacity. There's great interest in that, including in here in New York. But even moving as fast as we can with nuclear, it's still several years away before these reactors come online. But in New York and in New England in general, More natural gas in the energy system can drive down electricity prices now and lower home heating costs. So there's huge upsides to do in the short run, and there's great ideas with nuclear in the medium term. We're for both of them. We're for anything that lowers electricity costs for Americans.
And of course, when we talk about the mix for electricity generation, we have to talk about coal and this strategy and investment plan that was issued by yourself and your colleague, Secretary Burgum, over at Department of Interior yesterday. We saw the coal stocks move on this news, too. What does it mean in terms of coal as a generator of electricity? I think there are a lot of folks out there that think maybe that's going backward instead of forward. How would you react to them?
Yeah, I think they've got the directions backward. We've seen that political motivation. Coal's out of fashion. We're going to get rid of coal plants. Governors across our country have been forcing the closure of coal plants. What's been the result? 25% price rise in electricity prices when President Biden was president in just 4 years. And we didn't grow our production of electricity. We didn't do anything to bring data centers or drive prices down or reindustrialize our country. In fact, President Trump got elected to stop the blackouts, stop the rise in electricity prices. Coal's the third leg of that triad. That's the backbone of our electricity system. Natural gas is our biggest supplier of electricity. Nuclear's number 2, coal's number 3. Those are what make our lights stay on. Those are what set our electricity prices. If we don't cannibalize them, force them to close, and make them turn on and off all the time with subsidized wind and solar. We're okay with wind and solar on the grid, but we got to stop the subsidies and we got to stop killing the reliable sources of electricity. Coal's not just electricity. Of course, it's also used in steel making, cement making, and other industrial activity. So absolutely, we're going to stop the penalization of coal, let it compete in the marketplace. 16% of U.S. electricity today. We need it.
And of course, critical minerals come out of the ground when you mine coal as well. And some of the best quality coal in the world is actually here in the U.S. and goes into some of these advanced manufacturing capabilities as well. Perhaps doesn't get talked about enough. So how do you see this mix, this energy mix continuing to evolve then, especially as there's this focus on both bringing energy prices down for consumers and businesses, and then, of course, making sure there is enough energy to meet the growing demand of the soaring compute capacity of the AI players as well?
No, so great question. So by our math, to have the U.S. lead in AI and start the reindustrialization of our country, we need to add about 100 gigawatts of firm capacity in the next 5 years. When I arrived and President Trump arrived in office, there was a plan over the next 5 years to shut 100 gigawatts of firm electric generating capacity and only build 22 gigawatts of new. So a net reduction of almost 80 gigawatts. We want a net addition of 100. So obviously, it is a dramatic pivot in electricity policy in this country. We're going to stop closing power plants that are still viable and critical to our economy today. And we're moving as quickly as we can to permit, build, and enable the rapid construction of as much new capacity as possible. Of course, we're going to run the grid smarter, too. Use backup generators that are sitting there. Get rid of silly air pollution laws that don't allow us to run reliable capacity that's sitting there today, sitting there idle while we have blackouts and brownouts and spiking electricity prices. So fortunately, with how wrong things were done, there's just massive room for improvement. But electricity grid is big and it's complicated, so it does take some time to make major changes.
How does the fact that the federal government is poised for a shutdown come midnight tonight affect this entire conversation and what you do at the Energy Department?
Oh, it's tricky. The president is keen, and I think working as hard as he can to keep the government open, keep everyone busily working on everything they're doing. That is absolutely our objective. What the Energy Department does is essential for people across the country. But look, the Democrats, I have 20 Senate-appointed people on my team. They only approved 2 of them until about a week ago. And in fact, they weren't going to approve any more. The Republicans in the Senate had to change the rules just to get my teammates with me to help energize America. So this obstructive behavior from the Democrats, it's not good for America, not good for Americans, and it's certainly not good for energy prices. So hopefully saner heads prevail, the government stays open, and we can all keep working 7 days a week to lower electricity prices.
Okay. Chris Wright, Secretary of the Department of Energy. Thank you for joining me here on the exchange. Guys, I'll send it back to you.
Thanks for having me.
Thanks very much, Morgan Brennan, along with Energy Secretary Wright. Coming up, Pfizer, one of the few big pharma companies that didn't announce a multi-billion-dollar capital commitment in President Trump's push for domestic drug manufacturing. But Pfizer is now the first company to agree to voluntarily lower drug prices. We got the details and who could be next.
Plus, Nike set to report results after the bell. Shares on track to snap a 4-month win streak. We'll look at what the street's expecting and the status of the company's turnaround plan just ahead. The exchange is back after this.
This is The Exchange on CNBC.
Trump announcing a drug pricing deal with Pfizer, which will voluntarily sell its medications for less, including discounted drug prices for Medicaid. Pfizer is up 5% on the news. Angelica Peebles joins us now with more. There was a teaser, too, that other drug companies would have announcements to come also.
That's what the president said. We haven't heard anything yet. I've been checking in. Nothing to announce there. But, you know, this is interesting, right? Of course, we've been hearing from all these companies. Just yesterday, we talked about it. Everyone's been saying they've been in negotiations. But today, Pfizer, the first company to actually strike a deal with the administration. So what's happening? They're committing to a few things. They're going to lower prices in Medicaid. And then they're getting a 3-year exemption from tariffs on the condition that they invest more in the U.S. They're also agreeing to sell some of the drugs through this new website called TrumpRx, which is a DTC, direct-to-consumer platform. And they're also promising to launch new drugs at parity, so the same price here in the U.S. as other countries. Now, it sounds like a big deal, but I do want to take a little bit of a measured approach here, because some of these drugs, right, the drugs that they're selling directly to consumers, only one of them is actually broken out in the earnings report. So these are older drugs. They don't make a lot of money. These are not the huge blockbusters that you might be familiar with. And so even though it sounds like, yes, these prices are coming down, these are significant discounts, Pfizer's not really giving up a whole lot here. And also Medicaid already gets the lowest prices around. So, clearly this is working out for Pfizer and it gives them certainty. You can see the stock move today, but not giving up a ton here.
I was going to say Pfizer's playing this perfectly then if it doesn't have to give up too much. And Bourla, the CEO of Pfizer, Albert Bourla, is saying this satisfies all of Trump's requests. He has also had some very favorable comments about Trump in the past, saying perhaps he should win the Nobel Prize for his role in the searching for a COVID vaccine. So it's masterful administration playing, so to speak, on the part of Pfizer, which has been just a dog in the pharma sector.
And it was interesting listening today to this press conference. First of all, Bourla complimenting the president on having the coolest office out there, and then saying, though, that, two things that have weighed on their stock and really the whole sector have been the uncertainty around most favored nations drug pricing and tariffs. And this deal gives them a way to clear that uncertainty. They've, removed the overhang. This gives investors certainty. And again, you can see that reflected in the moves today.
Yeah, and all the other names as well. And presumably most of these companies are doing some kind of investment in the U.S. already, right? So it's not necessarily huge commitments. In terms of the direct-to-consumer portal or whatever this is going to be, so you get your prescription and then just shop there and see if these products are available?
Exactly. And Pfizer is saying that they're going to offer most of the drugs in their primary care portfolio. These are some drugs you're probably not familiar with, some, for eczema, postmenopause, bladder, rheumatoid arthritis. So these are, these again aren't the big drugs. And, if you have insurance, right, then theoretically you can go and get them at a lower price using your insurance. This, there of course are people who have to pay high copays or don't have coverage. But really, how many people are going to pay out of pocket if they have coverage? And so, this DTC, we've really seen all of this momentum where companies are saying, yes, we'll do it. We will sell these directly to consumers. But then the question becomes, how many people actually do that?
Yeah, with all the rebates and coverage things. And yeah, it's so complicated. Angelica, thank you. All right, coming up, the emerging markets ETF hitting its highest level since summer of 2021. Also on track for a record 9-month win streak. We'll look at what's driving the action and how it stacks up against the rest of the market. The Exchange is back after this.
which has, 10 turns.
Way cheaper.
Yeah.
Absolutely. There's no doubt about it. If it becomes a value-centric type of environment, it's going to benefit.
Yep.
Yeah.
All right, now to Bertha Coombs for our CNBC News Update. Bertha.
Hey, Melissa. The FCC today voted to move forward with a plan to consider allowing mergers between the nation's largest 4 broadcast networks, which includes NBC, owned by our parent company Comcast. The FCC is also considering whether to end or revise a rule that keeps a company from owning more than 2 of the 4 biggest TV stations in any local market. A federal judge today ruled the Trump administration violated the Constitution when it adopted a policy targeting pro-Palestinian campus activists for deportation, writing that the administration was suppressing free speech on college campuses in violation of the First Amendment. The judge's decision today considers only whether the administration used an unlawful policy. A plane load of about 100 Iranians being deported back to their home country is headed back after a deal with the U.S. government, according to the New York Times, which says the identities of those on the plane and their reasons for trying to immigrate to the U.S. were not immediately clear. Melissa, back over to you.
Bertha, thank you. Bertha Coombs. Coming up, Nike reports first quarter results after the bell today. The stock has moved double digits following 3 of its past 10 reports, and the options market is pricing in an 8% move today. We'll take a look at what the street is watching for next.
Welcome back to The Exchange. Nike shares slightly lower ahead of its results after the bell today. Courtney Reagan joins us now with the key numbers to watch ahead of that report. Hey, Court.
Hi, Mike. Yeah, so there's a lot of focus on Nike results after the bell. Investors really are wondering if this athletic retailer can show signs of acceleration after saying last quarter that most of the expense related to the turnaround is now behind it. So sales are expected to fall about 5% year over year to $11 billion on earnings of 27 cents per share. Now, smaller competitors like On and Hoka, they've seen their quarterly sales grow 32% and 20% respectively in each of the last quarters they reported. On October 14th, that'll be 1 year for CEO Elliott Hill as CEO of Nike. Shares down about 16% since then, down about 2.5% in the last 3 months. But analysts have gotten more bullish in the last 6 months, with more than half now recommending shares as a buy or an overweight. But that transformation, it's ongoing. Old inventory still being cleared through to make way for new innovative product as some of those wholesale relationships are being rebuilt. Now, there have been some job cuts, but also some restructuring by sport within the company rather than by men, women, and kids. Investors are interested, too, in the initial traction from that newly launched Nike Skims partnership from just last week. So don't have a lot of data yet, but it's working to regain ground with women. And this could be an interesting look into how maybe that's going with the new product line. Now, tariffs continue to weigh on the business, of course, along with weakness in China. The trade deal that was in place between the United States and Vietnam now for imports is 20%, a 20% tariff rate. That is actually less than the proposed in April, which was 46%, but more than the 10% tariff rate when Nike last reported a result. So investors are going to want to know about the higher cost. Is that impacting business and its forecast? Previously, Nike talked about $1 billion in costs from tariffs. We'll see if that number stays where it is or moves higher. A lot of questions about mitigation.
Yeah, Court, a lot of folks also pointing at, the search for catalysts out there. We got World Cup next year.
Yeah.
Maybe that's going to be a bit of a boost. I guess the test is going to be whether there's been any longer-term impairment to the brand as the company tries to get itself in order operationally.
Yeah, exactly, right? It's the qualitative stuff that's a little hard to get your hands around, right? Like what does the brand image look like, particularly with people that are looking for performance? Because Nike moved a little bit more into the lifestyle and the athleisure area. And you also then have competition from the likes of an upstart like Vuori, which has really gained traction. So I definitely think something like a World Cup, to your point, that really brings sport back to the forefront and performance is a good test for Nike's new innovative product to see if that gains some traction. But of course, Nike has to hope they haven't lost some of their consumers to some of these other brands, if indeed they were giving them what Nike wasn't for a while, like On with its new running shoe, for example, or if it was lifestyle they were looking for and they weren't loving Nike and they moved to Vuori, for an example.
For sure. All right, Court, thank you.
Thanks.
Let's take a look at two other big brands that have been beaten down so far this year. Starbucks and Chipotle among some of the worst performers in discretionary. Chipotle shares down about 35%. I mean, it's worth noting Nike, for its part, it's trading at levels 2018-ish levels or so. And when it comes to Starbucks, Starbucks was first in mind when it came to comparison because it has this big global brand.
Absolutely.
And for some time, there had been some difficulties in China, and that really hurt these businesses, and you wondered whether or not those franchises need to be marked down in terms of valuation because of the China exposure, as opposed to it being a benefit.
Starbucks and Nike ran to enormous premiums during the pandemic. There was a sense out there that it was just going to be these kind of bulletproof American brands that travel globally that was going to retain their value. That's now been compromised to a fair degree. I also have kind of put Disney in there with that because they also did have a pandemic bump and some China dependency as well. When it comes to Chipotle, it seems a lot more about just a little bit of a stall in terms of market share and mind share and price sensitivity to their offering.
Well, which is similar to Starbucks, too.
Yeah.
$6 for a coffee.
Right.
It's a lot of dough.
Exactly.
Coming up, Amazon now the only Mag 7 stock in the red this year as it seemingly falls behind in AI. But the company just announcing a slate of new Gen AI gadgets at its annual hardware event. Can Amazon catch up? We got the details next. And we're watching shares of Spotify down just about 6% right now after the company announced founder and CEO Daniel Ek will step down and move to the role of chairman on January 1st. Ek will be replaced by Spotify's current co-presidents. The exchange will be right back. Amazon unveiling long-awaited updates to its Echo, Ring, Fire TV, and Alexa Plus digital assistant at its Devices and Services event today. Mackenzie Segalis has more in today's Tech Check. Hey, Mac.
Hey, Mel. So Amazon is out with a refreshed slate of devices, including those new smart speakers and voice-activated displays. And what is key here is that they're all being turbocharged with Alexa Plus, its generative AI assistant. Now, today is also very much a test for Amazon's device chief, Panos Panay, the former Microsoft hardware exec now overseeing Amazon's biggest push yet to bake Gen AI across its devices. Now, he said this morning that customers are shopping more with the upgraded Alexa Plus assistant, a sign that Gen AI-powered commerce may be gaining traction. It also comes as OpenAI and Google roll out new shopping tools this week, which is seen as an easy first step toward AI monetization. Amazon also saying today that the rate of smart home adoption with Alexa Plus has doubled. Now, it was only earlier this year that the company unveiled Alexa Plus. Its limited release model has capped adoption, something the company is looking to fix, as all new Echo devices will have Alexa Plus going forward. But early customers of Amazon's Gen AI tool have given it mixed reviews. And critics would also argue that these Alexa upgrades lag far behind what OpenAI, Google, and even Meta are offering. Shares of Amazon are in the red so far this year, making it the worst performer of the Mag 7. And today's big unveil isn't doing much to change minds. You've got shares down 1 and change so far today, lagging the NASDAQ. Guys?
When are these devices available for sale, Mackenzie? Does this coincide with the prime fall days that are coming up?
They're going on sale today. And so this is also a key part of their Prime strategy because a lot of the Alexa Plus subscription model is baked into Prime if you have that. And it's also baked into a lot of these new products, which is really key because part of the bottleneck for adoption has been this rollout strategy geared toward early release. And that's why we're talking in the range of single millions versus the 600 million Alexa devices that are out there.
All right. Mackenzie, thank you. Mackenzie Segalis.
Coming up, we'll bring you an exclusive look at J.P. Morgan's long-term AI plans and sticking with the banks. Earnings kick off in just about 2 weeks. Deutsche Bank raising price targets on the big banks and some larger regionals, including Citizens and Truist, remaining bullish thanks to solid fundamental outlook and mostly reasonable valuations, despite the recent bank outperformance. And you see those stocks down actually kind of appreciably today. We mentioned the consumer credit weakness earlier. All right, the exchange will be right back. Welcome back. CNBC getting exclusive access to JP Morgan Chase's AI plans and how the bank is being, quote, fundamentally rewired for the AI era. Banking reporter Hugh Son, the first outsider to see a demonstration of JPM's platform, which is called LLM Suite, a portal created by the bank to harness large language models from OpenAI and Anthropic. LLM Suite was able to create an investment banking deck in about 30 seconds, something that would normally take a team of junior bankers hours to complete. Obviously, taking some cost out there, maybe also revealing that, you know, investment banking presentations are kind of a cut and paste job. I mean, it's sort of, and it's known to be, you know, kind of busy work that needs to be done to prepare the senior bankers to go and pitch clients.
There is something to be said, and I don't want to sound like man shouting at the cloud from the lawn, but, you know, those junior bankers later on become senior bankers, and they learned a lot by spending hours putting together that deck. So there's sort of that notion of, you know, how do you develop the next crop of future leaders, people who are in the banks at senior levels?
This is something that the banks themselves have pointed out when people sort of look at their culture and say, look, isn't this just too intense? So much of this kind of all-nighters for the junior bankers and stuff. So it is an issue, although I guess the industry always kind of migrates toward higher value add and complexity. And, you know, I remember talking to the CEO of Morgan Stanley way back in the 90s. How do you stay ahead of the commoditization curve? He said, well, 10 years ago, most of our bond salesmen were calling up clients and telling them where the 30-year was trading. You know, so I guess in theory, we can do it. But I don't know where those Excel Olympiad winners are going to go. Because you know those things? Yeah.
They'll figure out some other competition, I'm sure.
I would hope so, something important.
But this does show the monetization. And so we've been sort of struggling about the spend. Companies are spending.
Exactly.
What is the payoff? Here's a tangible example.
Productivity is the payoff, it looks like,
Coming up, burnout, betting, and bowls. That's next in Rapid Fire. The Exchange will be right back. Welcome back to The Exchange. Let's catch up on a few more stock stories on our radar. Time for rapid fire. First up, the Financial Times reporting Elon Musk's, quote, relentless demands and political activism have accelerated executive turnover across his businesses, with XAI among the hardest hit after its CFO and general counsel left within a week of each other. And while Tesla has also seen turnover, Canaccord is bullish, upping its price target by $157 to $490 a share and raising delivery estimates. It seems like the consensus on the street these days, at least for Tesla, is increasingly bullish as we head into third quarter numbers. We're getting delivery numbers on Thursday, and they're expected to just knock the estimates.
And the
over.
sell side just won't fight it anymore. I mean,
Right,
just the wave
exactly.
of buying and just on the upgrade. He says Mag 7 trades at 21 times 2028 earnings. So Tesla should trade at twice that, 42 times 2028 earnings. Because.
Right. He also says we had struggled with the downgrade back in January, left it, and so we sort of had that same exercise with this note with the price target raise.
Stuck
so
with
ultimately,
it,
stuck with it. Next up, we touched on Amazon's hardware announcements earlier today, but the company is also teaming up with FanDuel, allowing users to link their accounts to their Prime Video profiles for real-time betting updates. This comes on the heels of Amazon's recent partnership with rental car company Hertz, which will offer car buying online, used car buying online across the country with Amazon. So Amazon's sort of going into all these areas.
Yeah.
What won't it do?
They have the
nothing.
interface. They have all the customers, all the information. Why not exploit it?
Right. And finally, Jefferies writing that the pullback in Kava presents a buying opportunity. Shares about 65% off their 52-week high hit back in November. Jefferies attributes the dip to disappointing same-store sales, but expects those to improve through next year and says other fundamentals remain active. The whole sector has been terrible.
Sector's been tough. Super expensive stock, and it's sort of paying the price for that as well.
And super expensive bulls.
Exactly, all of it. All right, that's it for us. Thank you for watching The Exchange. Power Lunch starts now.
They may be bullish on bulls, but the stock market is moving lower as the specter of a government shutdown looms. Welcome to Power Lunch, everybody. I am Brian. Kelly is off today. Well, we're going to hit the markets and your money and also bring you some very surprising stats around government shutdowns, including why the very term shutdown itself is just a little misleading. Plus, a very rare interview with the chief designer for Tesla. We'll talk about what may be next for the brand, and from the road to the water. And put on your suit for this one, your swimsuit, because the CEO of Malibu Boats is here, and he is bringing some toys with him. They are outside, and we will go see them here in a few minutes. We got a lot to do, but we are going to begin, of course, in Washington and the looming government shutdown or partial shutdown. The Senate expected to vote again on an 11th hour stopgap measure this afternoon that would keep the government funded, but only until November 21st. Let's get the very latest on where we stand as the news changes and breaks minute by minute and hour by hour. Emily Wilkins on Capitol Hill with what we know now. Emily.
Hey, Brian. Well, yeah, you're right. The next vote is expected to take place later this evening, but we have already been told that we can expect that vote to fail. Remember, that's the one you need that 60-vote threshold. You need at least 7 or 8 Democrats joining Republicans. At this point, the numbers are just not there, and we just don't expect them to get there by the end of the evening. Democrats really here holding out to get some sort of provision on health care, and that in turn has ratcheted up what we could see if any potential government shutdown comes. President Donald Trump just now chatting with reporters about what the impacts could be. Listen to what he said could happen in a shutdown.
We can do things during the shutdown that are irreversible, that are bad for them and irreversible by them, like cutting vast numbers of people out, cutting things that they like, cutting programs that they like.
We already know that the Trump administration is looking at not just furloughing federal employees, as is normally done during a shutdown, but actually doing massive, large-scale government layoffs. And now we might have some more specific numbers from the Congressional Budget Office putting out a notice this afternoon that in the event of a shutdown, they expect 750,000 furloughed employees each day. That could lead to $400 million of total compensation costs. And remember, during a government shutdown, federal workers don't get paid, federal contractors don't get paid, folks in the military don't get paid, so huge potential economic impacts there. The Congressional Budget Office going on to say those impacts could be very far-ranging into the private sector, saying that the CBO expects that if a government shutdown persists for several weeks, some private sector entities would never recover all of the income they lost as a result of the suspension of federal activity. Of course, it remains to be seen exactly how long a shutdown would go. The longer they go, the worse the impacts tend to be. We do know that if a shutdown is going to be in place on Friday, it means we're not going to get job numbers. It also means that the Bureau of Labor Statistics isn't going to be collecting some of the key information that the Fed and other economists look to really get a sense of where the economy is. And that, of course, Brian, is just one of hundreds of impacts that could come. And at this point, it's very uncertain. It's certain we're going to go into a shutdown at this point. It's very uncertain exactly how long it would last. Brian?
All right. Emily Wilkins on Capitol Hill. For now. Emily, thank you. All right, so let's stay on that topic. And it's an important point when you hear the word shutdown, because when you hear shutdown, it's easy to assume that everything, I mean, the entire store is closed. Not the case. Let's welcome in PIMCO's head of public policy, Libby Cantrill. Libby, welcome. 750,000 people, huge potential impact. But I do want to remind our audience that I think this is critical because a lot of people are scared. People get Social Security. They use Medicare for health care. They're scared. Let's be very clear. During a, quote, shutdown, people still get Social Security. They still can access Medicare and Medicaid. The Federal Reserve operates. The military operates, though back paid. Law enforcement operates. Air traffic control operates. TSA, again, back paid. Let's hope they come to work. Impacted by a shutdown would be, as Emily said, government data. The jobs number's not going to come out. Government services. You got national parks and weather services. So it's not a complete shutdown, is it?
It is not a complete shutdown. Actually, if you look at the annual federal budget, around $7 trillion, we're really only talking about a quarter of that budget. This is the stuff that Congress appropriates, that they fund every year. As you said, it does not affect Social Security. It does not affect mail service. It does not affect Medicare. It does not affect the Federal Reserve, something that we, of course, are paying attention to. But what it does affect, as your previous commentator was just saying, in terms of data, which is quite critical at this period of time, and also those, not only those 750,000 furloughed workers, but this is actually quite important. There's about 100,000 additional workers who will have to show up to work but also won't get paid. So we are looking at kind of the range of 1.5 million folks who will not get paid. Now, do they get back pay? Yes, they do. But it
still hurts when they're not getting paid.
It still hurts. And a short-term shutdown, as I think everybody understands, really is not a macro event. It does not tend to be a market event. But should this be prolonged, there could be some non-linear effects. So the longer it goes, the more it hurts consumption, the more it could hurt.
By the way, we shut down a lot of American cities for other reasons a few years ago, not minimizing this one bit. But what's interesting is that, and look at this chart from Deutsche Bank. Sorry, I had to reference it. It's their chart, Libby. It's their chart. Is that stocks tend to go up when there's a shutdown. Not minimizing the shutdown. Painful for a lot of families, painful for a lot of businesses that rely on government workers, delis, whatever it might be. But the stock market doesn't seem to care.
Yeah, the stock market has been, and I think understandably, continues to be sort of inured to this sort of political dysfunction, if you will. What you've seen, I don't know if that chart had captured this, what you see is usually risk assets selling off into the shutdown. So the first day of the shutdown,
maybe like today.
Sell off, exactly. And then they do their sort of a relief rally, if you will. In our world, what you also see is that yields end up rallying. There usually is sort of this flight to quality, if you will, flight to safety. That benefits treasuries. Dollar usually sells off. Gold also rallies. And that's sort of, you're seeing that as well today.
But do we know why? Well, why?
Well,
because the market just thinks by now we're used to it. The government will eventually, quote, reopen. It's just a measure of how long it lasts.
Yeah, so I think that is the operable question here. And, talking to clients this morning is really what they're asking. How long can this shutdown go on? Again, if this is just a matter of days, even if it's less that the last time that we saw a full discretionary government shutdown was back in 2013. That lasted for 16 days. The catalyst to reopen that was the debt ceiling deadline in mid-October of 2013. There is no such catalyst here. So I think the concern is that if we do shut down, and it looks very likely, it's something we've been telling clients for the last couple of weeks, is that there may not be a natural, impetus to actually reopen the government, and that will have an economic impact and then probably will weigh on markets.
And you have said that, I know, because I read your work.
Thanks.
By the way, it's excellent work, as always. You and the
Maybe
entire...
not as snazzy as a boat, but
We got boats later. We got boats later. We're going to end on the fun stuff, start with the more serious stuff, but here's the reality, too, I guess, is that political parties, doesn't matter which party you're in, okay, red team, blue team, whatever. When the other team's in charge, you have a political strategy, I assume, to want to blame something on the other guy or the other team. So if one team's in charge, are we more likely to have a shutdown? Because then you could be like, well, it's their fault. And I don't mean either party. I mean, each party can do this. And if you're on the radio, I'm pointing both ways, because you can blame the other team for what happened, but you don't want it to go on so long that you really crash stuff, because then just people get ticked off at both teams.
Yeah, I mean, usually government shutdowns have been losers for both parties. I mean, there's really no...
As they should be. You both kind of look incompetent, right?
Yeah, absolutely. And you just think, okay, if Congress and the government has sort of one role, which is to keep the lights on, and they can't even do that, it does not necessarily, increase, folks, faith in the operation of the political system or what have you. I think, again, the big issue here, and one of the reasons why we do fear that this could be a little bit of a longer shutdown, is because it seems like the incentives of each party is to kind of keep this shut down.
You really think so?
Well, because the Republicans, I think for good reason, are saying that they've done what they needed to do. They've passed a clean government funding bill to mid-November, kind of a bridge, devoid of partisan riders. The Democrats, which usually has been, at least historically, the party that has wanted to keep the government open, they are the ones that are insisting on, arguably attaching something that really isn't relevant to the funding bill. And so I think they are trying to break through with their political base. They're trying to show folks that they are sort of fighting the president. They really haven't had an issue that they've been able to kind of rally around, and this is it. So again, this is just the political incentives, unlike other shutdowns. The political incentives seem to be pointing to a longer shutdown versus a shorter shutdown. We'll see.
Okay, well, we shall see. And as we showed earlier from the firm that shall not be named's chart, that stocks tend to go up. But is there a point in a shutdown, and I hope we don't find this out, that things break? Things really start to crack. The market cracks, the economy cracks, the bond market cracks, whatever it is, something cracks. Because during COVID, of course, we shut a lot of stuff down, but we also had big stimulus bills that could help businesses get through those periods. Some areas stayed closed for a couple of weeks, some for a couple of years, but we tried to incentivize that. Is there a point at which there is a breaking point?
Yeah, so the last, and again, sorry, we're kind of, the last sort of partial discretionary government shutdown was back in 2018. That lasted for 34 days. And you did actually see, some heaviness in terms of markets and what have you. But you also saw some stress around air traffic controllers, because asking folks to show up to work and not be paid, absolutely, yes, as you can imagine, one pay cycle, that's okay usually. But if it is prolonged, that does weigh on morale, it weighs on engagement, it weighs on who's showing up. And so for these critical services, these folks who are not getting paid, I think that is sort of the breaking point from the government services perspective.
Yeah, it's well said, and we'll see what happens. Let's hope, if this shutdown does occur, that it is brief. Both sides make their point. They get to go on TV and be like, we told you so. And then we just move on with our lives, because that's what tends to happen. Libby Cantrell of PIMCO. Must read research always. Libby, thank you. All right, also, let's take a look at oil today, because oil is actually down about 1.5%, on pace for its third straight negative quarter. Energy was the best performing sector a few days ago. Today, it's the worst. You got Baker Hughes down 4.5%, Schlumberger, Halliburton all lower as well. Some talk that OPEC's going to add more production to the market. Again, maybe not an all-out market share war, but certainly more oil, particularly when you have a Chinese economy which is not growing very quickly. Good for the price of gas, probably, if the price of oil continues to go down. We're going to take a short break. We're back right after this.